it's more a question of enjoy the party but dance near the door. At some stage, you have to pay the piper here. There's got to be, at least 2 trillion of new financing every year for the foreseeable future. When it comes to the gold price, I think you've also got to factor in what the Federal Reserve is doing. We're in an environment now where you want to be closer to real assets than financial assets. You may make more money in silver in the short term, but at the end of the day, what you want is monetary inflation hedges, and gold is a pretty decent one. The gold price doesn't go up. The gold price actually, in reality, technically stays where it is. Gold is the pole star in the financial sky. Now is the time to try and create a recession in the US.
All right, how's it going, everybody? Thank you for joining me on this episode of Real Money Talks. The second one for this week, I know. And as always, I hope you've been having a great week so far. But if you haven't, then you are, of course, at the right place. And even if you have had a great week, then you're still at the right place, because Michael Howell and I are talking about where inflation is going and how much more money printing, if any, he is expecting over the coming months, as the fiscal and monetary landscape is, of course, shifting, not only on a national level in the US, which is a little bit more obvious, but also just generally on a global level. And of course, we're going to look into how that ties into gold and silver prices. Of course, after Michael, though, I've got a good old CEO barbecue lined up, two actually. One of which is going to take us all the way up to the Yukon to look at a 2 million ounce gold deposit that's going to be with White Gold Corp, and see really if there's any potential left there and exploration upside. And then the other one will take us down to Nevada to look at Ridgeline Minerals and their recent high-grade drill results, which they've done in a partnership that they have with Nevada Gold Mines. But liquidity concerns first, because Michael, you and I spoke last quarter, I believe. So I suppose no 10-minute intro needed here. Everyone knows who you are, the liquidity lighthouse, as some like to call you, though I don't think anyone's ever called you that, but I should be the first one, lighting the way through the monetary waters. But I'm rushing to talk to you about the recent pause that you've noticed in global liquidity expansion, which you've said is related to essentially three things. So we have the slowdown in central bank liquidity growth. There's the increased volatility in the bond market. And then there's China's central bank that has an inconsistent policy action, or inconsistent policy actions, really multiple. So already we're dealing with things that are obviously way over my smooth head. So maybe we can try and detangle these by going over those three things kind of separately, one by one, and see how they really tie into global liquidity, as well as, of course, how do they influence precious metals. And I want to kick it off with non-Chinese central banks. And I'm specifying non-Chinese because I do have other specific questions about the PBOC later. But so, Michael, do you expect central banks to keep limiting liquidity growth? And if so, how is that going to influence gold and silver prices?
Well, the short answer is no, I don't. I don't think they can. I think their ability to reduce liquidity is very limited. We're in a world of monetary inflation. I think that much is clear. The reason we're in a world of monetary inflation is there's so much debt out there. We're hooked on debt. We can't get out of debt. We keep accumulating debt. But debt needs to be refinanced, and the only way to refinance debt is really against the backdrop of generous liquidity provision. That's what we've been seeing, and that's what we're going to continue to see over the medium term. I think the problems nearer term are basically about a number of things. One of those, as you rightly say, is that bond market volatility has picked up because the bond markets are sniffing out some of these problems, and they don't like what they see with this sort of disregard among central bankers really about inflation. And although central banks have this rhetoric that they're trying to kill inflation and hit 2% targets, the reality is that there's something else going on. And I think you've just got to see how the Federal Reserve operates to basically realize that. The Federal Reserve, is intent on a 2% target, but how do you measure that 2% target? They give us a range of different indicators, whether it's PCE, whether it's core PCE, core consumer prices, whether it's core services, whether it's headline CPI. I mean, who knows? There's a range of these different things, could even be wages for all we know. And they seem to miss all of them, but they cut interest rates. You've also got a situation whereby they don't tell us anything about what happens if they stray away from their targets. So in other words, if they undershoot inflation, what's their reaction function? We just don't know. They seem to be cutting rates kind of regardless. And that's not just a US phenomenon, that seems to be pretty global. So central banks want to cut rates. I rather suspect the reason for that is that the debt burden on treasuries around the world is becoming now pretty immense. You just got to look at what's happening with the US to evidence that. Something like 30% of US debt, which is a figure of about, well, I mean, the US debt is a figure of about 36 trillion US dollars. 30% of that has to be financed next year, refinanced next year. So there's a continual rollover. The average interest rate on existing US debt is just under 3%, so 2.8%, in fact, which represents about a $1 trillion interest bill. The average interest rate across the curve in the US is currently 4.3 and probably rising further. So if you look at that and just do the math, the interest bill is going to rise from $1 trillion this year to 1.2 trillion next year. It's claiming that's obviously a 20% jump. I mean, these things just can't keep going on. And therefore, there's a great need to keep interest costs down, which I think is the modus operandi behind decisions to cut interest rates. I think that this is a major thing. Now, what does it tell us about inflation? It says that inflation is a battle which has not been won, and basically it's been pushed to the side. We've long suspected that a Federal Reserve that used the word transitory to describe inflation is not a central bank that really wants to tighten. So I think the backdrop here is that, notwithstanding short-term problems, which are all about rising bond market volatility, concerns over maybe Trump's near-term agenda, all these sort of things are coming to the fore, and they're disrupting the supply of liquidity near term. The reality is looking longer term, unless something is done. I'm talking here something drastically is done, like Elon Musk goes in and sort of basically cuts out most of the US government, or taxes are hiked, or whatever. I mean, unrealistic options. We're in this road, or following this road, of more monetary inflation, and therefore the gold market does well. And I think that investors out there have just got to look at a very, very simple relationship. Since year 2000, the stock of US debt has increased by a whopping eightfold, and the price of gold has gone up 8.25 times. That seems to be a pretty consistent relationship in my mind.
Yeah. And that's exactly why I was asking about this, because I'm wondering how central bank liquidity growth is related not only to retail investment demand for precious metals, but also to their own demand for precious metals. So central bank gold buying, essentially. Is there a relationship that you've observed where debt goes up, therefore the gold reserves of banks go up, or is there any relationship that you've seen there?
Well, I think that there's another factor out there that you're alluding to, which is basically the buying, particularly of non-Western, in other words, BRICS banks of gold. Now, this is a comparatively new phenomenon, and it seems that these central banks are actually buying gold as an alternative to the US dollar. They're putting their reserves in bullion. The reserves of the BRICS and friends of the BRICS, in other words, those countries that aspire to join the BRICS group, now surpass US holdings at Fort Knox. So, I mean, these are not inconsiderable amounts, and they're continuing to rise, whereas obviously US gold reserves flatline. So, these are considerations in the longer term. Now, that's telling us that the amount of gold out there in private hands is diminishing. Okay, partially obviously new production, but on the face of it, central banks are buying gold from the private sector. They're taking it out of circulation, and therefore the private sector has less gold to buy. On top of the fact that demand from the private sector is building because of monetary inflation features. So, why shouldn't gold go up? It does go up. I mean, this is the reality, and it's going to keep going up until one of those two factors change. And I can't see why they should.
What I'm also thinking about is how stable or how sustainable really is this liquidity growth that we're seeing in this debt growth and everything. And yeah, I'm thinking about inflation versus deflation, but on the other hand, I'm also thinking about just the stability of the global financial system. I know this sounds very dire, but could what's happening here, could this result in a potential global liquidity crisis at a certain point? I mean, the liquidity growth cannot keep going on forever, right?
Well, I mean, the answer is that it seemingly can, because it has, and it's done so for decades. What we're really talking about is maybe two things, two dimensions. One is the nominal amounts here. In other words, how much monetary inflation there is. I mean, clearly, if as I said to you earlier on, I mean, the stock of US debt has gone up 8 times, in the last 25 years. What's to stop it going up another 8 or 10 times in the following 25 years? I mean, probably nothing, because it will. I mean, that's the reality of this, right? So one is this sort of is how it's denominated, the nominal value of that debt. In other words, inflation is going on the whole time. So that's one dimension, and the other is what is the stability of the system. So if the direction is upwards, the stability is the other question, and the stability really relates to how easy it is to refinance debt. Now, most financial crises, if not all financial crises, are about liquidity, not solvency. In other words, it's your ability to refinance your positions. Now, if you look back and you look at the GFC in 2008, you look at the Asian financial crisis, you look at the US repo crisis in 2019, all those were examples of periods where debt could not be refinanced. Okay, so the central banks had to come in and create more liquidity. And the reality is that what we've got out there is a stock of debt which is valued at about $350 trillion, which has an average maturity of about 5 years, which means simple math that 70 trillion has to be refinanced basically every year. Now, $70 trillion of refinancing is a huge amount, and it puts a lot of strain on financial markets. And to roll over that amount of debt, what you need is balance sheet capacity or balance sheet capacity among credit providers. Now, that is what we define as liquidity. So if you get some misstep where debt or the need to refinance debt exceeds the amount of liquidity in the system, then you get a refinancing crisis. And that's what we've seen historically before. If you go to the other extreme and you see a lot of liquidity relative to the needs for debt refinancing, you tend to get asset price booms. Now, actually, as it happens, because of low interest rates through the COVID period, where central banks basically operated zero interest rate policies, a lot of debt was termed out, into 2026, 27, 28, etc. And that is the so-called maturity wall, which is coming back to bite markets in the next few years. It probably begins about the middle of next year. And basically, those borrowers will have to refinance those positions. Now, that will take liquidity. And, we've been in a luxurious position for maybe 4 to 5 years now. There hasn't really needed to be a lot of debt refinancing. Inflation has been, erratic, but it's been up and it's been down. That's taken some liquidity out of the system. But generally, there's been sufficient liquidity to fuel asset price booms. The question is, looking forward, you've got three big challenges. Number one is that the underlying level of inflation in the world economy may be higher, and that will sap liquidity. Number two, as you alluded to, that China is a major uncertainty here, and China is a dollarized economy that uses vast amounts of the US currency. And the third thing is this debt maturity wall, which will need refinancing. So whether the global liquidity cycle is expanding or not, you've got increasing demands on that. And one of the problems about the statement about global liquidity, expanding, is that increasing bond market volatility basically dents near-term growth in global liquidity supply anyway. And those are the concerns we've already got. So, we're not saying bail out now, this is the end. It's more a question of enjoy the party, but dance near the door. That's the sort of the investment message.
Mm. But liquidity in the US specifically with the Fed seems to be, well, it's showing signs of stabilizing right now. If it, do you think it can? Do you think the market is pricing in a longer term slowdown in liquidity or stabilization? And if it actually did happen, what does that mean for markets?
Well, I don't think the market looks sufficiently at liquidity, so I don't think they've really priced it in. I mean, this has been this over fixation on interest rates. But we're in a world, I mean, this is the point that we keep making, is that if you pick up economics or finance textbooks, what they keep telling you is that capital markets are all about interest rates and about raising capital for new investment projects. That was the world we used to be in 50 years ago. It's not the world we're in now. We're in a world where capital markets are all about debt refinancing. That debt refinancing mechanisms actually whopping or huge debt refinancing mechanisms. And that's all about balance sheet capacity. It's not about interest rates. So this fixation that central banks push us towards and the media, persuades us it's all important. What's Fed funds rate going to do tomorrow or whatever is completely meaningless in a lot of ways.
What if the Fed introduces technical changes, as you've written about too recently, that kind of increase liquidity, but much more subtly than what we're used to so far? Do you think that's going to have an effect on commodity prices like gold and silver, or do you think that the impact is going to remain marginal?
Yeah, I think it is going to have an effect. I mean, it's going to have a major effect because at some stage, you have to pay the piper here, and you can massage markets, manipulate markets for so long, but at the end of the day, you kind of you've got to, as I say, pay the piper. I mean, there's no getting away from that. And the problem that you've got right now is that the Treasury and the Fed have been remarkably successful in holding bond yields down. I mean, we think that if you look at the US Treasury market at the 10-year tenor, yields should be about 100 basis points higher than they currently are. And the reason that they've been suppressed is that the Treasury has been doing what we've loosely dubbed as not yield curve control, yield curve control. It's an unconventional yield curve control, but they're doing it. And that's largely through a mechanism of increasing issuance at the short end of the market. So they're doing a lot of bill issuance. For example, in October last month, they issued almost $2 trillion of treasury bills. Now, set against a US debt outstanding of 36 trillion, that's quite a meaningful amount for 1 month, right? So they're doing a lot of bill financing. They're doing a lot of financing in terms of very short-term maturity coupons. So 2, 5, or 2, 3, 5 year coupons. Those are short-term bonds of that maturity, and they're really starving the market, at least temporarily, of longer dated debt, which is the reason that yields are probably below where they should be. But we know there's a lot of debt coming in the future of all stripes. So there's got to be, at least 2 trillion of new financing every year for the foreseeable future, arguably more than that. And there'll be a lot of that will be coupon. In other words, there's been a sort of a short-term blip whereby the percentage of US government debt in treasury bills or short-dated debt has picked up significantly. The share has gone up, but the share can't keep rising. It's got to level out at some stage, which means that coupon supply has got to, at the longer end, has got to pick up. And that will actually put a lot more pressure on yields. So you've got this problem. Now, if yields keep going up, then the interest bill of the US government starts to skyrocket. And this is really the problem that not just the US, but everybody really has to face. And if you're suppressing yields by 100 basis points across the curve, let's say, you've saved the US taxpayer, or you've saved the US Treasury the need for $350 billion of funding. I mean, these are big amounts. So it pays for them to do this, and they're doing it. And then on top of that, the Federal Reserve is increasing liquidity through what we call not QE, where they're basically, allowing debt to roll off their balance sheet, but they're basically pushing liquidity in through other means. They don't want to, they don't want to crash the markets. And as my former boss at Salomon Brothers, Henry Kaufman, sort of very cleverly pointed out 2 or 3 years ago, that a Federal Reserve that uses the term transitory to describe inflation is a central bank that doesn't really want to tighten. And this is what's going on. So they're letting inflation basically run away. I mean, not at super high levels, but sufficiently, whereby it becomes a nagging problem. And the issue for equity investors generally is that they're being excoriated, if you like, by a sort of naggingly high inflation rate and a bond yield that is forever creeping up. So we're sort of being sandpapered to death slowly, rather like we saw or markets saw in the late 1980s, when, for a long time, the equity markets decoupled from the fixed income markets until they didn't. And then there was the crash. So these are problems we've got to face.
That really begs the question as to why, and that may be the most important thing here. That also that this maybe doesn't have a very specific answer, but the decision-making process, what do you think that's mostly driven by? I mean, are they becoming more data dependent again, or are they still constrained and commanded by other pressures? I mean, fiscal and political and whatever else may have you.
Well, I think they're pressured by fiscal problems. I would suspect that the reason that rates are being cut, not just in the US, but even if you look at the UK with the Bank of England, where it's difficult to argue that inflation is seriously under control, I must admit, in all these countries, but policymakers still want to cut rates. I think they're being guided by the interest bill their governments face. They want to get their interest bill down, and they see that cutting policy rates at the short end is a mechanism to do that. But they've got to face the problem, which is a problem that emerged in the 1980s of bond vigilantes. If the bond markets or bond investors start to believe that these fiscal policies are unsustainable, then they're going to go on a buyer's strike and allow yields to push up. And that's the problem we've got. Now, in the case of the US, it's a little bit more knife-edged than it was in the 1980s, for the simple reason that what you've got is a very unusual cast of buyers at the margin of the US Treasury market. The US long-term institutions, the pension funds and the life funds, have really been squeezed out of the market. They're not really big buyers so much. And at the margin, it's basically been hedge funds who have been doing a basis trade. In other words, they've been buying the cash market and shorting the futures through an arbitrage. Now, that works until it doesn't. But what that really is dependent upon is some stability in the bond markets. You don't want bond volatility to pick up. And what have we seen in the last few weeks? Bond volatility has jumped significantly. Now, it has fallen back, admittedly, since the election, but it's still, over 100, whereas the long-term average on the MOVE index is nearer 70. And that corresponds to a circa 7% volatility across the curve. So you're roughly speaking 50% higher levels of volatility than we normally see.
I definitely want to get to the bond issue or whatever is happening in the bond market right now. But I want to stop by China first, because what the PBOC, the Chinese central bank, has been doing is they've been showing inconsistency in the speed at which they've been injecting money into their system, essentially. Is this behavior more typical of larger underlying economic and debt issues, or are they just being strategic and proactive with their actions here?
Well, I think they've been consistent in the sense they've been consistently negative. So I'd say that's what we've seen recently. And I don't think they're being strategic. I think they're being actually tactical. And I think that what you've got going on in China is, number one, still a desire to stabilize the yuan as much as they can. And this is a big thing in China. They seemingly want the yuan to basically peg itself closely to the US dollar. And they're prepared to tighten monetary policy in the short term to do that. Now, that may be, as I said, tactical, because the election or prospective election of Trump, and the fact you've now got Trump winning the election, means that their eyes are focused on what that would mean for the Chinese economy and what that would mean for tariffs. And clearly that will focus the mind. And probably what they are concerned about is exchange rate weakness in the near term, if the markets or if Chinese investors themselves think that this is actually very bad news. So they've got a very tight monetary stance. Now, does that tell us anything about the longer term? I don't think so. The Chinese have sort of alluded to a package today, which would suggest they are prepared to issue maybe 10 trillion yuan, so just over a trillion, maybe a trillion and a bit, or in dollar terms, of debt. I think if you want to scale that, it probably should be nearer 2 to 3 trillion, pretty much equivalent to what the US did after the GFC. Maybe China's problems are bigger, so perhaps we're talking more about 3 trillion. But hey, this is a start, doesn't rule out further increases. But the most important thing out of this is, how is it financed? And we don't really know that. And there could be, people can speculate, but we really don't know. We don't want to know for months how it's financed. Because is that money going to be raised from long-term savers in China? In which case it's not really a genuine stimulus, and it really is just reshuffling the deck. It's not doing very much about solving these underlying debt problems. Or is it going to be monetized by the banks, which I rather think it is, because that's the solution to debt problems everywhere. And it's been, it's well trodden ground through history that this is how you get out of major debt debacles. China's got to follow that same route. Effectively, what they need to do is to get the banks to buy government debt that will first of all improve the debt quality, or the asset quality rather, in banks' balance sheets, because they've got a lot of rubbishy real estate debt that is probably completely worthless. So having more government debt there at least improves the quality. And if the banks do that, they can expand their balance sheets and effectively monetize the overall problem. But that does mean, two things. One is that the banks will have to have a bigger capital base in order to do that, to expand their balance sheets. Well, hey, the Chinese have actually already agreed to do that, so we think that that is likely coming. And then the other factor is that the cost will likely be a weaker yuan exchange rate. And that's something which may anyway be inevitable given the tariff policies that Trump is threatening.
I'm also thinking about the grander scheme of things, though. If China would adopt a more aggressive liquidity policy with a lot more money printing, slashing rates, and other liquidity incentives, but it's again stuff that way over my smooth brain. But could their actions on the national level offset any liquidity tightening we see in the West? If that were to happen, I understand that's not your case, but I mean, yeah, could they kind of change the situation on a global level by doing stuff on the national level?
Yes, I mean they could. I mean the PBOC, make no mistake, the PBOC is the most important central bank for when it comes to commodity prices. I'm not saying specifically gold. I'm talking more generally about industrial commodities, simply because China's industrial footprint is so big. So if the PBOC is tightening policy, then that's bad news for commodities. If the PBOC is easing policy, it's extremely positive for commodities and the tempo of the world economy, particularly the Asian economies. Now, the Chinese need to get back to easing quite quickly. They've basically been tightening for some considerable time now, which is one of the reasons the world economy is sluggish. But there is, as I say, there is evidence that maybe we are moving towards a regime where the Chinese are prepared to ease more aggressively. But we'll see. When it comes to the gold price, I think you've also got to factor in what the Federal Reserve is doing. And gold is much more of a monetary related commodity that has, it gets its traction from what world central banks are doing in terms of monetizing debt. And that's a general phenomenon, inside and outside China. So I think those are the features. I think that, if you come back and you say, well, are we in a world ultimately of tight money or loose money? I think in the medium to long term, we're in an environment of looser money, because I think that, the ability of governments to tax is very restricted worldwide. They simply can't do that to the extent that they could. There, is a risk. Having said that, maybe more wealth taxes, because that's an easier way of grabbing tax revenues, but that's going to be hugely unpopular. So I think they basically have to go down the route of monetization of any spending they do. And I think that if you start to extrapolate what could happen in a Trump 2 regime, I think you could basically see a situation where you've got increasing tariffs, but maybe the analogy is that this is like the British Empire situation in the 1930s of what was called imperial preference. And that was basically a tariff regime that built a wall around what was then the empire. So countries like India, Canada, the dominions are in the Australia, New Zealand, etc., which had very favorable terms or no tariffs with Britain. But anywhere trading outside of that bloc saw big tariffs. Now, that was deeply, deeply unpopular in the US at the time. And a lot of US endeavors through World War II, through Lend-Lease and whatever else, and bailouts for Britain at the end of the war, all about dismantling that imperial preference thing. So it wasn't a popular move. But actually, the more that one looks, a lot of the errors, mistakes, tactics, or whatever that Britain employed as its empire was in decline, from the 1920s onwards in the wake of World War One, the US is going through now. It's doing many of the same reactions. The fiscal backdrop is maybe not dissimilar. You know, you've got a lot of mandatory spending. Britain had mandatory spending. There's defense spending to take into account. And so maybe an imperial preference system of tariffs that basically embrace or a wall surrounding US allies is a sensible thing. And maybe the condition for being in that group is that there's very favorable policies to the US, including Europe funding it's taking its fair share of defense spending, for example, things like that. So, all these things are up for grabs. But if that occurs, then you're going to have the world very clearly cleaved in two or three different divisions. And the Chinese or the BRICS world is more and more autarkic relative to the West. Now, if you look at what then happens, using the 1930s as a parallel, there was a scramble for resources because resource deployment or where resources were available didn't neatly fit into those economic zones or those tariff areas. And so there was a scramble to get whatever resources you could, and that clearly pushed up the price. The other thing that happened during those periods when there was a lot of government spending required, particularly government initiatives on getting access to commodities and defense and whatever, was more and more monetization. So, that would have been, that's a wonderful background for real assets. And it may well be that we're in an environment now where you want to be closer to real assets than financial assets.
That, well, the most interesting part about that for me in this specific context of this conversation is that China recently announced that they had stopped buying gold, but their unpredictable approach to liquidity makes that questionable as well, to say the least. What do you make of the strategy around diversifying the composition of their reserves partly with gold? Do you expect them to keep doing that? Because you're saying that's what you want to do. You want to stay closer to real assets, not financial assets. But on a central bank and national level, is that what the BRICS bloc and China in particular wants to do here?
Well, I wouldn't necessarily believe what the Chinese are saying about not wanting to buy gold. I mean, we've got to distinguish anyway between the private sector in China, which clearly has a huge appetite for gold, and if there was any hint of currency devaluation of the yuan, the gold market would spike significantly. So I think you've got to think about that in itself, separate from the fact of what the Chinese government is doing with its reserves. And they may well have made that statement to try and cool the gold market so they could get in and buy more at a lower price. I mean, that I'm sure that's just tactical. I mean, how else are they going to hold their assets? I mean, China's got a huge surplus. China's great problem is, it's got an ability to invest globally because they've got surpluses, but they've got very few places that they can put that cash, which are not political. They can put it in gold, yeah. Okay, they can do the Belt and Road Initiative, but that's sort of pretty unattractive at the moment. No one really likes that so much. They can put it in US treasuries. Okay, that's deep enough and liquid enough. Like put it in Swiss francs, but I mean that's such a tiny, tiny market that it's sort of the lunch bill for China. Or elsewhere. I mean, where else do they put it? They don't want to put it in the euro because that's just a clone of the US, and it's probably a flaky underlying currency anyway. So you've got gold as the main alternative. So I think that that's where they're going to push more of their resources. And then I think, the other thing to say is that, the easiest way for China, if I was a Chinese strategist, the easiest way of destabilizing the Western system would be to encourage all your BRICS colleagues to start buying gold. I mean, that would be the obvious thing because then you're starting to threaten the integrity of the dollar system. Gold is your challenger. And the next thing China would do is then to start military spending. And, China has the ability to do that because it's got more fiscal space than a lot of Western countries. That military buildup can be completely unspecific. It's just a general buildup. The US has got to match that, surely. NATO has got to match that. And who's going to pay for that? That's going to wreck fiscal finances. And the only way you can pay for it is monetization. So therefore, you start to weaken paper units against gold. And so the gold market, I mean, I can't, gold to me it's almost a no-brainer. It's got to go up.
Hmm. How do I know you're not a Chinese strategist, Michael?
Well, I don't know. Just take a look. I can assure you I'm not.
Considering that silver is more volatile and economically sensitive than gold, though, and jokes aside here, do you think silver could still perform well in an environment of higher liquidity out there, but maybe more economic and debt challenges, or does it risk underperformance compared to gold once again?
Well, I mean, the thing is with silver, there are more moving parts. I mean, it's always been called the restless metal, and that really explains, I suppose, a lot of the backdrop of silver. Silver can spurt ahead or fall back significantly around a rising trend because it's an industrial metal. It's more speculative. You've seen big bubbles in silver. It's a thinner market, etc. Why not just keep it simple? Why not just go for gold? I mean, that seems to be a pretty decent thing to buy. I mean, you may make more money in silver in the short term, but at the end of the day, what you want is monetary inflation hedges, and gold is a pretty decent one. I mean, by all means, invest in Bitcoin. That seems to be a pretty sensible monetary inflation hedge. Diversify, put money into silver too. But I mean, the point is that you want precious metals and other monetary inflation hedges because we're in a world of high debt, and the only way that you can get this debt down is to monetize it. Simple as that.
Is that not true for almost all commodities that have either an industrial side to the demand profiles, or the ones that are full blown industrially driven, like copper, for example?
Well, I mean, the way that I tend to think about this is to say that, if you look at industrial commodities, they've got two moving parts. They've got a currency of denomination effect, which is, let's call that the dollar gold price. And then you've got a real exchange ratio, which may be the copper to gold ratio or the oil to gold ratio. And those are basically real economic relationships that tell us much more about the state of the industrial economy, the efficiency of supply, or whatever. Those are those sort of factors. So you think about those two moving parts. If you get monetary inflation, the gold price will go up in dollars or yen or euros or whatever. That's for sure. And assuming those real exchange ratios for the various commodities stay unchanged, then you also got a similar increase in industrial commodity prices to what gold's doing. If you get a boost in those real exchange ratios because the economic cycle is picking up or their local supply difficulties or whatever, then you're going to make more money in those commodities. But then equally, you could go the other way. You get recessions or you get, excess periods of excess supply or whatever. I would tend to think that if you're looking forward, you've got both monetary debasement going on, and you've got a prospective shortage of a number of selective commodities, not least because the various political interests are trying to grab them as easily as they can or as fast as they can. And
Hmm.
that clearly is what China's doing with a lot of sensitive minerals.
Well, I was thinking specifically about copper, but the rare earths are maybe interesting too. So again, for other industrial commodities like copper, could we expect greater demand pressures if the PBOC's policy inconsistencies continue, potentially creating supply issues in China?
Yeah, I would have said. I mean, at the end of the day, look, the integrity of the Chinese system really depends on rising incomes for the Chinese population.
Yeah.
And what they can't afford is serious setbacks. And if they have to create growth. And so the Chinese model is basically all about expanding supply. If the West is not going to come up with a cash flow to buy those goods, then they have to use more and more debt to keep the thing rolling. But that's the problem they've got themselves into. So, the way they get breathing space is to monetize the huge debt burden they've got at the moment and then start again. But everything here points towards higher inflation. And I think that the question to ask, I mean, everyone's got to ask personally. I mean, I ask this all the time. What's my personal inflation rate? Sure ain't 2%. I mean, it strikes me that it's much more in double figures, and I'm sure I'm not alone. So the reality is we've got a lot of inflation anyway, but the metrics that governments force down our throats, these CPIs or core CPIs, don't adequately reflect them. The fact that you've got stocks soaring, you've got the gold price soaring. These are all evidence. This is all evidence of monetary inflation going on.
Hmm. This might be a good point to actually do talk about those bonds, because with bond market volatility spiking to what you call a 20-month high, as you recently wrote about, could we see increased interest in gold and silver as stability hedges to not only the inflation that you're talking about, but also this volatility? Or is there a risk that liquidity constraints, at least over the short run, might weigh on the prices of gold and silver?
Well, I think the answer is why not? They are, they're pretty decent, safe assets. And I mean, the question you've got to ask more and more is, are government bonds really safe assets in a higher inflation environment, and in an environment where regulators are increasingly pushing banks and other financial institutions to hold government bonds as a must-have? They've got to have them, right? That doesn't necessarily mean they're safe anymore. May mean they're necessary. But these are they're becoming forced buyers of these things. So I would say that gold and precious metals are pretty decent inflation, or safe assets and decent long-term inflation hedges. Now, to come back to the point about what happens in a liquidity crisis, well, in a liquidity crisis, you sell what you can. And not surprisingly, particularly if you go back to 2008, the gold price fell because gold was a liquid asset that you could liquidate pretty quickly, right? So people sold it. Now, did the gold price stay down? No, it didn't. It rebounded again. Once the crisis was over. And I think that's the way to think about this. During crises, these things can be highly volatile, but you want to be buying them, not selling them during the crisis, because they're going to come up the other side, because the only solution to these refinancing crises is more liquidity. That's what we've seen time and time again. If that doesn't happen, the system defaults, and we have no more financial system, no more economy, whatever. The lights go out. Now that ain't going to happen because policymakers won't let it happen. So they're going to pump as much money as they can into the system to keep it running. And the gold price goes up. Well, in actual fact, I'm wrong here. The gold price doesn't go up. The gold price actually, in reality, technically stays where it is. Gold is the pole star in the financial sky. It's everything else that basically devalues against gold. And that's really the way to think about it more correctly.
Yes. One of my friends, Lobo Tigre, calls it the dollar to gold exchange ratio. And in an exchange ratio, if the price of gold goes up, then one of those is either going up or the other one is going down. And in this case, it's the dollar going down. But what you just said there, Michael, might be an interesting point to go into as well, because with higher volatility in bond yields, how do central banks balance the need to keep borrowing costs manageable while also avoiding excessive liquidity that could fuel not only the inflation that we're talking about here, but also hyperinflation?
Well, we're not in the realm of hyperinflation yet, and I think that what you've got to see to get hyperinflation is radically, and I mean radically, higher rates of monetary expansion, and we're clearly not seeing that. So I don't think there's a chance of anything like that. That's another step. Another step. But we are seeing, naggingly higher levels of inflation. And, think of it this way. I mean, if I'm correct that if you look at the US Treasury market, take the US Treasury market, is yields are suppressed by maybe 100 basis points at the long end through the way the Treasury has issued or corralled the market, cleverly corralled the market, then the break-even inflation rate from the TIPS market is about 100, 120 basis points higher than current readings. So that would say that actually 5-year inflation is probably nearer 3 and a bit% than the 2% central bankers claim. Now that's not that bad, but hey, it makes a difference because it means that your real returns are clearly going to be eaten into. It also, by the way, happens to explain why you've got the yield curve as a really poor economic indicator of late, because if you add 100 basis points back to the long end of the market, the yield curve never inverted and never signaled recession. It was basically signaling a flat to slightly upward slope curve, which is probably telling us about slow growth, not recession. So I think that a lot of things become explicable or more understandable if you realize that the Treasury and the Federal Reserve are in cahoots to suppress yields across the curve. They're doing yield curve control, but they're not fessing up to it. It's an unconventional yield curve control. But hey, it's still yield curve control in my book. I mean, if you want evidence of that, just look at the extremely wide spread that you've got, unusually widespread between US treasuries and mortgage agency mortgages in the US. I mean, that very high spread is indicative of the fact that the bond market, the treasury bond market, yields have been pushed down.
But could persistent bond market volatility pressure the Fed or other central banks to implement, more obvious or bigger, as you call it, unconventional monetary policies, like just more aggressive yield curve controls, and what is that going to mean for commodities?
Well, I think it depends what you're really talking about explicitly. I mean, I think that what could they really do? I mean, they could get. I mean, if you start to run through the sort of the gamut of things they could do, they could basically say, well, okay, let's get the Federal Reserve to start buying more government debt again. Okay, now, in other words, restarting QE. Now, the question is that's a double-edged sword. So in the short term, what that does is it reduces duration available in the system. So it reduces the supply of coupon debt in the market, and therefore you're going to get a scarcity effect, which will clearly pull down yields in the short term. But you're simultaneously expanding the balance sheet. You're pushing more and more liquidity into the system. You're reducing, therefore, systemic risk. In other words, about refinancing, which means that investors' demands for safe assets fall away. So at the end of the day, you may get a short-term boost to bond prices, but in the longer term, bonds are going to sell off because fewer people want them. So actually, by doing that, yields rise. So that's kind of a difficult one to enact. This is what I'm trying to say is that, if you look at what they're doing at the moment, their clever tactics have been basically to starve the market of duration in the short term. But there's only so far you can use that. Okay. They're now running out of road. They're losing their control of the market, and yields are slipping away from them, and they're basically moving up. And you can see that by looking at a breakdown of the treasury market in terms of risk-free, terminal policy rates, risk-free interest rates, policy rates, and the term premium in the bond market. Now, those two moving parts make up 10-year yields, let's say, or longer dated debt yields. Terminal policy rates really key off the momentum of the economy. Now, I don't think the US economy is showing any signs of cooling down particularly. I think the growth looks to be pretty decent. That's what Jay Powell was saying yesterday. He was also alluding in the presser to the fact that doing a survey as the Fed does among major corporations, many major corporations were pretty upbeat about next year and even indicating that growth could be better. So if you've got that sort of environment, it's pretty unlikely you're going to get big drops in policy rates, or certainly it's hard to justify. And then if you look at the term premium has been skewed downwards by a number of factors. One has been historically low volatility. Another has been, let's say, low inflation uncertainty. And a third thing has been the fact that there's been a shortage of coupons for the very reason that the Treasury has not been issuing them. They've been issuing bills instead. Now, all three of those factors which have suppressed term premium are unraveling and pushing term premium up. It's ain't a US phenomenon. This is happening globally to bond markets worldwide. So term premium are on the rise. And if you just add those two components, terminal policy rates and term premium together, you understand that bond yields have only got one way to go, and that's upwards. Except, and this is the exception, if there is a recession which is forcibly created. And if I was a policy advisor to Trump, and I'm not, I would say now is the time to try and create a recession in the US, because now is your best opportunity to clear the decks, to blame everything on the previous administration, to do what the socialist government in the UK did, which is basically open the books and say, oh, look, there's a nasty black hole here that no one realized. We've got to raise taxes because of those damn conservative government that came before us didn't know how to do simple math, and therefore, sadly, everyone's taxes have got to go up, even though we said we'd never do it. Now that's given them a cop out. I mean, few people probably believe that story, but nonetheless, that's what they've argued. And why couldn't Trump do the same? Just blame everything on Biden and Kamala and say, look, they just completely lost control. Sadly, I said I was going to keep tax cuts going and I was going to boost all the spending, but I can't do that now. I'm going to have to wait 2 years before we got everything back in order. He creates a recession, gets yields down, finances a lot of debt longer term, and then goes for the spending boost. And then, what we have is another Republican administration in 4 years' time. That would be sensible tactically. Don't
Well,
think they're going to do it.
well, you said you're not an advisor to China. You're not an advisor to Trump either, but it seems like you can do both of those jobs very well. But the in the end, though, Michael, how much of this bond volatility is attributed to market speculation versus fundamental issues like government debt lows or fiscal uncertainty? Is this just kind of happening, or is it engineered? That's what I'm after here.
Oh, I think the bond volatility is really a feature. I mean, part of it is technical, bear in mind, because part of the jump that we saw in the MOVE index, which is the best bellwether of bond volatility in the US, was about the election. And it was because the election was coming into the 1 month window, forward-looking window for options, which is how they get their calculation of implied volatility. So that was the election. That's coming out, and consequently the MOVE index is dropping away. But you've got to look at the underlying levels of the MOVE index. The MOVE index normally is around 70, and you're now looking at levels of well above that. And I think that really is a testament to the fact that the underlying fundamentals of the bond market are deteriorating. Yields are moving up, term premium are pushing them up, and the range of bond investors is getting narrower and narrower, and it's now mostly speculative hedge funds who are doing most of the marginal buying, and they depend on low volatility. So this is a little bit like a sort of snake eating its tail, isn't it? It's a vicious circle. And if you start to get more volatility, what happens is the hedge funds buy less of that basis trade. That means volatility then pushes up higher. You get even less buying of the operation of the basis trade, and then the thing unravels. So the Treasury and the Fed have really got to keep their eyes on the MOVE index and keep it down. And when I was more active in the bond markets, a level of 150 on the MOVE index was sort of signaling that the authorities had completely lost control of the Treasury market, and it was sort of switch the lights out time. We got up to 136 about 3 or 4 days ago on the MOVE index. That's not far from 150. We've come all the way down to about 107 now, but nonetheless, I mean, we're still closer to it than we are at normal levels.
I recently stumbled on from something you retweeted or reposted, re-exed, whatever it's supposed to call it these days, from George Robertson, who you've kind of have an ongoing discussion with over time. And the conversation really got simple, got interesting when one account, it's called YOLO DD. He or she asked him, it's a simple question, and I'm quoting, it's a simple question. Do you think the Fed starving the market of long dated treasuries has suppressed their yield? Unquote. And George answered in one word saying nonsense. This is where I suppose you guys disagree on the inner workings of how that
Well,
control
I
has
think,
worked.
so partially what George is saying. I mean, what he's saying is that the Treasury market is, as I understand it anyway, he's the best spokesman. He's keyed off nominal GDP, right?
Hmm.
So, given the fact that issuance doesn't affect nominal GDP, how can that affect the bond market? Now, my view is that there are a number of ingredients. One is nominal GDP, which is affecting demand for bonds, but you've also got to take into account supply. There are two sides of a market, supply and demand. And if you increase lots of supply, you're clearly going to get a change in the price and yield structure, and that's exactly what's happening. I mean, you can look at it quantitatively, doing statistical analysis, robust statistical analysis, and it's absolutely as plain as anything that the skew in Treasury issuance has explained a lot of this yield suppression in the market. Not just a recent phenomenon, go right back to the 1970s. It's not a new feature. Whenever you start to see the calendar being skewed significantly towards one direction, long or short dated debt, you get a change in the yield structure. It affects the term structure. It's not surprising that happens. It
Hmm.
would be the only market. It would be the only market in the world where it didn't happen, where supply was completely irrelevant.
Yeah, well, that's exactly what he. So under that post, he said, "Tell me how can supply of U.S. Treasuries set the price of U.S. Treasuries? That is a fantasy," he says, and I suppose that's exactly where you guys disagree.
Yeah, because he's saying that essentially he's saying that the Treasury curve is the risk-free curve. Well, maybe there's a point on it which is the risk-free curve, but he's saying that's priced off nominal GDP. I think it is, but there's more to it than that.
Hmm. Good. This is actually a great part that I hadn't planned on, but I saw it sitting on the side of my screen here looking at Twitter. But this has been a great conversation, very wide ranging, and took a bunch of notes. What am I forgetting, though, to ask you here, Michael? What are you paying attention that you think is very important, but nobody's talking about?
Well, what I'm paying attention to most is what are central banks doing in terms of their liquidity injections, and B, what is the move index doing? What is the underlying integrity of the bond markets? And that's what's going to tell me a lot about liquidity. And as far as I can see, central banks are tentatively putting money in to markets. Partially what we've said about China and the Federal Reserve, the ECB is putting liquidity in. The BOJ is sort of adding, although not the same alacrity they were earlier on in the year, but nonetheless they're doing it. Other central banks, the smaller central banks, are adding liquidity. Generally, central banks are easing, so I think all that's good. I think the point that disappointed me in the FOMC statement on the presser yesterday was the fact that nothing was said about the balance sheet. Generally, I mean, apart from the fact they said they were going to continue what they were doing, no question was posed, nor did Jay Powell volunteer any answers in the presser about the balance sheet. They're going to have to address that pretty soon because the reverse repo is being sort of bled dry. And as Laurie Logan, who formerly used to run the system open market account, she said earlier on this year, when the reverse repo is run down, that's probably the time to stop QT or stop the roll off of debt from the balance sheet. I think that's got to be addressed pretty quickly because we're more or less there. And I would suggest that it has to be done in the December meeting, given it wasn't done yet yesterday.
Well, even if it had been done before yesterday, Michael, I would still be just as much out of my depth as I am now. But I greatly appreciate your time and efforts to walk me through this complex inner plumbing of our financial system. I always feel at least 20% smarter after I've spoken to you, Michael. So again, thank you for sitting down with me. And I'm looking forward to talking again sometime after that December meeting. It's going to be lots to talk about in the meantime too. But I'll let you drop off now, though, because it is time for me to do some digital traveling again before I can go into the CEO barbecue. But of course, not before my favorite part of every episode. And that is, of course, the disclaimer, right after which I promise I will jump into the CEO barbecue. But there is a warning on your screen right now, and you are obligated to read that one, and the other ones that are come after it. But you're also just better off actually doing it because this is not just some generic disclaimer. This is an actual warning that might help you not lose as much money, which, by the way, losing money is the norm. It should be the expectation in this sector. That's part of it. Money is part of it too. I am here to make money. I make money from the existence of this channel and specifically from companies paying for the production of their interviews. This is what this is. Now, in this episode specifically, it is Ridgeline Minerals who has paid for the production of their interview, and White Gold has not. But that doesn't mean you should look at this episode any differently or their interview, because even the companies that are not paying, they are likely still seeing their participation in this program as a chance to do some marketing. So start by understanding that most company communications online, albeit this interview or their presentation or Twitter account, their website, when you call up their IR person, that is all marketing. And although I don't make buy or sell recommendations because there is a clear conflict of interest, many out there will do, not only on YouTube, not only in the interviews. There's a lot of large Twitter accounts that do that for a living, make buy or sell recommendations after taking money from the company. And you should be aware of that inherent bias. That bias, unfortunately, is not always going to be clearly disclosed with everyone out there. So it is safer for you that anytime you're consuming whatever type of company specific content, Twitter, YouTube, whatever it might be, LinkedIn, their website presentation, just approach it with a dose of skepticism and treat it as marketing. Unfortunately, none of us are magicians. I'm not a magician. And that's one thing I know for sure. Maybe some of these people out there are. I don't know what they're claiming, but the guests here are also not magicians. The CEOs, they're not magicians. So we don't possess any superior knowledge about what will go up, what will go down, or what's going to go in circles. Also, unfortunately, try as I may, I call this show the CEO barbecue. It's meant to grill the CEOs. And I say that only half jokingly. I mean, my goal here is really to have a real conversation with the company and get to the essence of every story. I won't always be able to catch everything relating to a story. And if there are things going, if there are things that are not great with the company, I cannot promise you I'm going to catch all of it every time. And although you shouldn't tell my wife this, I'm not perfect. I'm not flawless. Matter of fact, I still have no idea what I'm doing. I don't have a long enough track record to prove to myself that I know what I'm doing. This is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. If you don't understand it, don't do it. In addition, no guarantees are going to be made here, besides that there will be forward-looking statements in these conversations. These are conversations that are general and impersonal in nature, and they're going to contain hopes for future events that may or may not take place, depending on many different factors, both within and outside of the company's control. Be aware of that. Be aware of the bias that goes online. Be aware of the inherent risk to investing and the increased risk of investing in non-revenue generating companies. And please talk to someone who can prove to you that they know what they're talking about and that they know what they're doing. How do they prove that to you? Well, a professional investment advisor is a good example. Professional investment advisor whose intentions and incentives you understand. A licensed professional investment advisor who has a good enough and a long enough track record. As well as, of course, in the end, do more research. Use your brain before taking any decisions. And you do research not on YouTube, not on Twitter, not on the chat boards. You do that on setterplus.ca. That is a government official website. That's where you'll find the company's official filings, like the financial statement, the management discussion and analysis, that's the MD&A, and their technical reports, as well as their management information circular, where you can figure out what the compensation structure is for the management. And there's a bunch of other documents there. That's where you find their news releases and whatnot. That's where you do research. If you don't do that, you are more likely to lose money. There are disclaimers on your screen right now. Again, if you don't enjoy losing money, read them and be careful out there. With all that said, though, I'm almost going to shut up here, because I'll kick off the CEO barbecue portion of today's Real Money Talks episode by traveling to Nevada. Once again, I seem to be spending quite a lot of time in the silver state these days, so it must be busy down there. Only this time, I'm not actually after silver. This time I'm after high-grade gold and maybe even some copper. Luckily for you, I'm not going on this trip alone, because I'm not the biggest fan of rattlesnakes and scorpions, but who is a fan of those apparently is Chad Peters. Chad is, of course, the CEO of Ridgeline Minerals, that's an exploration company. I like to think of it as a prospect generator hybrid exploration company in my mind. And of course, Chad's been on Research Talks many times over the last couple of months. We went through the story in depth multiple times, and there's even a playlist specifically for Ridgeline Minerals on the channel where you can go and where you can and should really go and listen to our previous conversations. But no special 10-minute intro here today, because Chad, you've had 2 news releases since we last spoke, so we have enough to talk about here today. And both of those news releases were related to Swift, with the first one starting a very nice move in your share price by the looks of it, and nice volumes too, but you were trading at a low of about 15 cents before the news, and then on the back of it, the price went as high as 23 cents, and that was in 3 or 4 trading sessions, and so it's a 55% spike. Despite you announcing a permitting delay that took you back a few months in that news release. And then when you actually announced the assays, which was yesterday, so a couple of weeks after that, on the 7th, the market barely reacted to it, despite you having drilled the highest grade intercepts. Though I understand it is rather narrow, but it is still 10.4 grams of gold over 1.1 meter. And that's within somewhat of a larger intercept of 2.7 meters, grading 7 grams. So what's going on here? What have you discovered? What's this market reaction?
Yeah, it's funny. You don't get to pick, always when you put out your press releases, like the market that you're putting your press release into, right? So when we put out our update in October, I think we were touching on $2,800 gold. Everybody was kind of getting a little bit crazy about gold stocks. And so we put out news just simply saying, hey, permitting's been delayed, but we did finish our first program. And assays are pending, and we like what we're seeing. It was literally the messaging, and we went up, like you said, almost 50%. And then we put out the results yesterday, which I'm very excited about. So you're right, I won't parrot your assays there, but it's a very significant press release for us, right? Like 2.7 meters of 7 grams is very comparable to the operating head grade of all of the combined mines in the Cortez district, which are owned by Nevada Gold Mines. So there's about 50 million ounces of historic production, current reserves in the Cortez trend across let's just call it 5 mines, underground mines that are kind of all cobbled together. The average grade of the current P&P reserves is 7.3 grams per ton. So this is a very material intercept, and NGM thinks it is as well. Barrick actually just inserted it into their Q3 results presentation in MD&A as a significant high grade intercept. And they included a table in their appendix and the whole thing. So Swift is certainly being elevated in the, call it the priority level within Barrick internally. We're really excited about what we're seeing, and this is how discoveries start. I mean, I've been a part of multiple discoveries in my career. Typically, you don't just slam into the heart of the zone in your first or second hole, right? It takes persistence, good geology, and that's exactly what the NGM team is doing by vectoring in on these higher grades. This is the first step in what I think is a much bigger development for this project, and I think we're heading towards a discovery.
So this 1 meter, 1.1 meter intercept, how do you know it's not just I don't know, a teaser or a high grade pocket that occurs in isolation? How do you know?
Well, so if we'd have drilled this, let's just say this was the first hole of ever being drilled in this area, right? Of course, we'd be excited to be hitting high grade in our first hole, but it would be tough to be able to say, well, we think that this is part of a larger zone, and here's why, because there wouldn't be much detail to support it. Thing is we've drilled 5 framework drill holes in this general target area over the last 3 years. All of them have hit wide intercepts of low grade gold in the exact same host rocks that we just hit this high grade, more discrete interval in. So there's a major thrust fault called the Mill Creek thrust that is underpinning this entire target area. And every time that you get the favorable host rocks intersecting the Mill Creek thrust or directly above the Mill Creek thrust with other cross-cutting structures is when you get these blowout zones. And that's exactly what this was. This was a discrete structural blowout zone that is, in the right host rocks, is, in the right vicinity of this Mill Creek thrust. Problem is the Mill Creek thrust was actually higher in the drill hole. We hit it higher or shallower than we expected to. So what that means is we only tested about half of the target horizon. So we should have tested over 1,000 feet of host rocks. Instead, we only got to look at about 400 feet of host rock before that fault sliced it off. So where we're going next with this hole 7, maybe to some folks it seems like a large step out being a kilometer away, but we're actually stepping to the west directly down the projection of that known Mill Creek thrust. And we're drilling right beside hole 3, which was 52 meters of 0.45 gold in the right same host rocks, but maybe not quite close enough to that big structural blowout that we now understand is controlling mineralization. So hole 7 is a very important hole. It's going to tell us a lot more information about how this Mill Creek thrust is mineralizing. But yeah, I mean, 1.1 meters at 10.4 grams is great. That's the first time we've ever hit high grade on this project. This is the kind of grade you need to have a significant discovery at depth in the Cortez trend. Now, that being said, the next step is, can we find that intersection where those 40 meter zones of low grade get turned into 40 meters of 8, 9, 10 grams per ton. And that's just a matter of just time and good geology of vectoring in and getting into those high grade structural zones. And I think for me, this hole gives me the confidence that that's more of just a matter of time now. It's not a if we're going to hit that. I truly think we're onto a discovery here. It is going to take time to just continue drilling holes, finding the right kind of sweet spot. And when we do, I think it will really matter.
Lots of things to touch upon there. I want to talk about essentially that thrust coming up at a different spot where you'd expected it. And also the next steps. It's also something we're going to talk about. Before that, though, you talked about proposed structural traps along the Mill Creek thrust too. So having seen that first hole, which apparently, again, the grade's there, but it also continues to show evidence of the Carlin type gold system. How confident are you now that the high grade is related to these proposed structural traps here?
Yeah, we have a pretty high degree of confidence that, obviously you have to have the right host rock. If you don't have an iron rich limestone, very permeable host rock, you're not going to get the fluids flowing out into the surrounding rocks. So that's step number 1. You got to have the rocks. We know we have that. But these discrete structures, these cross-cutting structural zones where they intersect the Mill Creek, that's where you're getting this massive blowout of fluid flow. And then when that hits the right host rocks, that's how it mineralizes and creates the deposit. So we're getting, call it before this drill hole, we knew that was an important component of the exploration story. This really solidifies that, okay, yeah, these cross-cutting zones, these faults, they're the key piece to the mineralizing story. And so we hit one of those in hole 6, and now we're stepping a kilometer away to another hole near hole 3. And that hole also had one of those big structures cutting through it right at the Mill Creek thrust. So now we have a higher degree of confidence in how we target that the right host rocks. And it's pretty much a matter of just everything coming together at the right point. And when they do, you end up with a discovery. And I think we're on our way to that.
Well, you do mention here, though, that the high-grade zone was found within a discrete fault structure. That's what you call it. Is this telling you anything about continuity? Like, why is it discrete? What does that mean?
So I think what we're trying to point out is, the Mill Creek fault is a very through-going structure. The thrust is a very through-going structure that cuts across the entire target area. The structure that we hit in hole 6, it sits, it's cutting directly across the Mill Creek thrust, so it's a cross-cutting fault zone. So and when they say discrete, we just mean it's one of the secondary structures that is cutting through and creating porosity, permeability, and fluid flow in the deposit. And so we want to hit these. It's critical to hit these discrete zones where they're intersecting that through-going Mill Creek thrust. And when you get that, that's when you get your big zone.
That's also, again, reminding me to go back to what I just said, or what you just pointed out that I wanted to ask you about. But there was, if I understand correctly, kind of, you didn't hit what you were expecting to hit, I suppose, from the structural perspective, which just proves that these things are structurally just not easy. But you essentially, you missed the part of the Hanson Creek and the slope facies limestone sections due to what you call higher than expected Mill Creek thrust. Yeah, so that's exactly what you said. That's what I wrote down, actually, just taking it over from the news release. Does that mean there's something wrong with the way you understand a geological model, or like what does that mean? Where is this coming from?
No, not at all. I mean, there's just so much structural complexity in these things, right? Like we're targeting blind targets beneath over 500 meters of just dead cover, right? So you don't get to see that structure at surface. See, what you have to do is you have to drill it, take structural measurements on it, drill another hole a kilometer away, see where you hit it, start drawing lines between, right? Now, the thing is there's obviously lots of complexity between those, so we initially drilled hole 2 and 3, they're about 800 meters apart. So we had a hit point on the Mill Creek thrust in hole 3, where we had Roberts Mountain, Hanson Creek, and the slope facies all preserved. And then we had a hit point on hole 2 where we only had the Roberts Mountain and a bit of the Hanson Creek preserved. So we drilled back between the two, closer to 2 than to 3. And we got a little deeper into the section, but the fault ended up being higher than we anticipated. So now we have one more anchor point. We drill hole 7. That's we're projecting the Mill Creek thrust to where we think we're going to hit there. If we hit, great. If it's higher or lower than we expected, then you have to adjust your model, right? It's very much an iterative process. So that's why the framework approach is so important with Barrick is we're looking for these big structures, and it's critical to understand how this thing is projecting across the target area, because the target itself is over 2 kilometers wide and 3.5, 4 kilometers long. This is a big search space, right? So once we understand how it's as we vector in on these zones, as we understand how that fault is propagating through, we can then start projecting into other structural targets, both to the north, south, east, in all directions, essentially. And that's when you go in and hopefully start hitting some better zones.
I think this also goes to show that your strategy of working with NGM here is the right path to explore for these kind of deposits. Because if you had to do all this on your own, it will cost you way more money. How much money is again being spent on all of your projects this year?
So we're seeing 4 million going in the ground, most of which is being going in the ground at Swift. Just on Swift alone, they've spent about $8.2 million through the drilling of hole 6. So think about that for a second. Like, we're a junior company. Our market cap hit, I think, $10 million at its lowest in this spring. There's no way I can raise the money to drill these kind of risky holes. Like, for us, if I was drilling at Swift right now, I have to be sharp shooting every single hole, just hoping that I hit a high grade zone, right? And that we have something that I can then raise money on and get folks excited about. That may be exciting in the short term, but that doesn't lead to significant discoveries, right? Big discoveries like what we're going for, you need to be methodical about it. And that's what partnering with Nevada Gold Mines has done, right? They're being slow, steady, but very calculated in how they're approaching the exploration here. And they're taking all the knowledge they've learned across, over 100 million ounces of discovery in Nevada over the last 40 years, and they're applying that knowledge into this project. So it's a huge win for us.
Hmm. There was a note about the budget, though, that there's a change in the budget. Now it's up to, what the first news release said, it's up to $3 million. Why? What's the reasoning behind the change?
Really tied into that permitting delay. So we were supposed to start drilling in June.
Mhm.
That May, June, that would have allowed us to drill easily 4 to 5 holes before the snow started falling, and pushed us out of the project. Because even where we're at, even though we're in Nevada, we get quite a bit of snow at this project. So it's not really drillable between December and let's call it, April, late April. So um, because we had to push it out till August, we just don't have the time frame to drill those holes in the budget period that we had intended. So that's why the reduction.
Yeah. Yeah. Okay. Why I'm asking that is because I'm thinking about so far they've spent, what about a third, 37.5% of the minimum $20 million spent. And that's it after what, 3 years of working together? Do you,
Yep.
do you still expect them to, or are you concerned about the pace of the spending that we're seeing from NGM? And do you expect them to spend all that money still on time?
Well, they certainly, yeah. I mean, there's a big balloon payment coming up as far as like they need to, and by balloon payment, I mean a big spending requirement for them. That's the wrong word. But they need to spend almost $11.5 million by the end of 2026 just to earn a minimum 60% interest in the project, right? So yeah, I'm not worried about it, especially after seeing this hole get drilled. Like this may have been looked over by maybe a lot of the retail crowd as, hey, a meter of 10 grams just doesn't get me fired up. Um, Kind of thing. But it certainly is exciting for Nevada Gold Mines, right? They know what this means. They know that we're on to something significant. And I think that this hole will push them to finish do their spending and within the time frame. But if we hadn't have had a drill hole like this, yeah, I'd be concerned, right? That's a big spend on a project that hadn't yet yielded an ore grade intercept. So
Okay. Well, so now I'm starting to better understand why you're more excited about this hole than what, again, maybe the retail crowd out there was. And you mentioned, or you compared this to some of the mines or all of the mines you said in the Cortez district. Is that how their discovery started? Like, or are they fine? I mean, how did they start off? Did they just also have smaller intercepts and then it kind of grew, or how did they discoveries work?
yeah, every project's different, but a great analog that's probably the most recent analog in the Cortez district would be the discovery of the 4 Mile deposit, which is owned 100% by Barrick, right? Which is the majority owner of and Nevada Gold Mines as well. It's directly on trend of the Gold Rush mine, but it's deep. So it took them 11 drill holes, 11 framework holes to testing to depths of over 1,500 meters depth. We're talking considerably deeper than what we're drilling at Swift. It took them hole number 11. They hit 5.8 meters of 49.7 grams, right? Obviously, awesome drill hole. If we'd have drilled that hole with hole 6, we'd be having a different conversation right now. But that was 11 holes in. We're only 6 holes in. So our project, I say, as far as when you're comparing how are we tracking against the typical kind of framework approach that Barrick uses to make discoveries, we're right on track. We're seeing the kind of ore grade intercepts that show that the system can produce significant high grade results. And I hope by hole 11, 12, we're firmly into what would be considered by anybody looking at the project a bona fide discovery. So yeah, I'm really excited. When you look at the Cortez complex, they essentially lump all of the underground reserves together, right? So the Cortez underground, which has the Hansen discovery that they're working on underneath, Gold Rush, which is going to be a 400,000 ounce a year producer in the next few years. Those all started just like Ridgeline or just like Swift is starting right now, right? As an early stage exploration prospect. So we're excited.
Is any of this changing your drill frequency or spacing or anything else really related to the drilling or this exploration program now that you know where it is and how much it is and how high grade it is?
Yeah, certainly. Just at a high level, it gives us an anchor point that we're going to start really tuning in on, right? Obviously. So I think with future drill programs, we will focus on following up directly on this intercept as well, down dip of it. But it's still very much in that framework approach that they're doing, NGM's doing right now. So hole 7's a kilometer away, but it's testing the exact same geologic concept as what just yielded the discovery hit in hole 6. So yeah, I think it's certainly changed NGM in our opinion of the project from where could the future of the project go? We're a lot more excited and bullish on what the future looks like for Swift, but we're still going to keep on plugging away at these framework holes, doing it. It may be slow and steady, but it's the right way to do it. And so next year will be a big one.
Well, now with this hole 7, essentially, you know that it's 1 kilometer down dip from hole 6, which we've been talking about today so far. But what exactly are you targeting there? What are you really hoping to see from, of course, from a grade perspective, but also from a structural and alteration perspective?
Yeah, we're hoping that with this hole, what we're going to see is we're going to see the projection of that same Mill Creek thrust, but it's far enough to the west that now we're preserving all of the prospective host rocks. So not only are we going to see a lot of structural complexity, especially right along that thrust fault. Like that thrust fault is moving just an entire like half of Nevada is getting slid along these faults, right? Like it's just massive amounts of rock being moved. That creates a lot of tension, a lot of fracturing in the rock, a lot of permeability. So that kind of rock, they call it, rock prep or ground prep, is what's required to create porosity and permeability for those fluids to flow. So that's the kind of structural trap when you get that ground prep tying in with the right host rocks, and then also having those discrete structures that we talked about cutting through, which creates secondary permeability, which again enriches the mineralization. That's what we hope to see with hole 7. That would be the best case scenario. We drill something more in the lines of the 30-40 meter intercepts we saw in the nearby hole 3, but we're seeing in significantly higher grade because we're hitting the right host rocks and the right spot.
Well, let us be optimistic here for a second. If that high grade scenario happens, what does that mean for Ridgeline as a company? I mean, where do you see it placing? How would you personally value a company that does have those intercepts and a company that, again, you're at about what, $14-15 million market cap right now? What does having those intercepts do to your market cap?
Well, it would completely re-rate the company, I think, in the eyes of the markets, right? I think that we would go from maybe being viewed more in that hybrid prospect generator pre-discovery kind of valuation. I think we would get bumped into a proper discovery. And I think, a good comparison might be like what Kennerland was able to do at Frotet. We have a 25% free carried interest at Ridgeline or at the Swift project. Kennerland was able to have a 20% joint venture interest in that Frotet discovery, and they're now trading anywhere from 90 to $100+ million market cap on any given day. So that's kind of the direction that I think short term project could head if a major discovery was made. But yeah, we need to see 10, 20, 30 meters of the exact same grade we just drilled, but showing that would be the scale and the grade. Right now, we've shown scale with low grade, and we've shown some nice high grade narrow intercepts. We need to get that combined, right? We're seeing both scale and grade in a single intercept, and that's where I think it'll be viewed as a real discovery.
Well, in the spirit of fairness, what if it's not there the way you hope it is? I know nobody wants to think about that, but what if? Where do you take it from there?
Sure. Well, the thing is this is a 75 square kilometer project. We've really only tested one of 3 primary targets on the project, right? So this is a massive land position. If you were to take our land position and just plop it, layer it over top of the Cortez complex, you'd fit Gold Rush 4 Mile and the Cortez mine within the footprint of our land position. So just, you think about that for a second and go, okay, this isn't the only target on the project. There's 2 other great targets that we would love to test that are similar scale. So if we were to never drill another great intercept over at Southwest Swift, then we move to Mill Creek or we move to the Goat Anacline. So yeah, there's great exploration potential there. And now that we know that we can host high grade, there's going to be other great targets to drill.
How's the exploration program going so far in terms of being on time, on budget, anything unexpected?
We're relatively on budget, obviously behind because the schedule got adjusted due to permitting. So yeah, little behind schedule, but I think we're tracking pretty well on budget.
Okay. When do you think you're going to have more results, and when is this going to be? When do you think the whole program is going to be completed by?
Yeah, hole 7 is going to be done by end of November. Take about a month, 4 to 6 weeks, depending on how quick we can get it out after that to the lab. So, we're talking early January for assay results out of 7. And it really comes down to the winter weather, right? Like if it does look like winter's kind of setting in, like it's getting pretty serious here. So I think by the end of the month, we're going to be seeing quite a bit of snow. And, that third hole may or may not get drilled, but that's, that's all right. It would just come back in the spring and once the snow melts and go after it again.
Okay. So, but you're not thinking of partial hole assays or something like that. You just want to do it hole by hole.
Yeah, no, I won't do. I think it gets dangerous when you start going into partial assays. So,
Sure.
if there's alteration and mineralization, we'll wait till all the assays are through. If we have absolutely stone dead rock that obviously isn't going to grade, I don't mind putting results out for stuff that's maybe grading above that or something like we did with this hole. But yeah, probably early January.
Oh, you did note, actually, reminding me of that, you did know that the bottom of the hole, so the bottom 156 meters of that intercept did not show significant alteration. What's that really telling you? Is that telling you something about the depth of the system, or what does that mean in its entirety?
No, really, it just came down to we drilled through the Roberts Mountain and actually had a bit of a fault. So we had a shorter section of Roberts Mountain than we expected, and then we dropped into the Hanson Creek limestone or Dolostone, and we dropped into the upper section of the Hanson Creek, which isn't that great of a host. The better host in the Hanson is actually in the lower section where it becomes more carbonaceous or like limestone, and that got faulted off by the Mill Creek thrust. So it just came down to the bottom 150 meters. They were not visually exciting. They weren't geochemically exciting when you look at the XRF, and it's mostly a function of just the host rocks, right? You got to have the right rocks.
Right. Okay. So, well, I think that about covers it, actually, when I think about it, because I asked you about the timing on 7, and you told about the rest. Well, I think, what else am I forgetting to ask you? What's important here with this release or with the next coming months? Anything else that you're expecting in the next few months?
Yeah, I think we covered it in pretty good detail on the technical side. I think something people like I'd like to point out to folks is, this has been a slow process for us, right? Like we've been public since 2020. We've done now 3 deals with majors, 60 million bucks, and these things take a lot of time to pull off and get the deals done. And I really think what's people should recognize is these deals are starting to work. Like we're starting, it's gone from okay, great, you've signed a deal with a major, congrats, but is it actually delivering value for your shareholders? Well, this is delivering value, right? Where before, we were drilling low grade intercepts and it's like, okay, maybe this isn't going anywhere. This high grade shows that, all right, this partnering with major companies to put their money in the ground first, and reduce some of that risk. It's working. I wouldn't have been able to drill these holes ourselves. I wouldn't have been able to drill those holes at Selena, which is why I partnered with South 32 on the Selena project, right? So we're really, I think, getting a lot of really good lottery tickets lined up for our shareholders. They're starting to pay off, and yeah, I think people should really start looking at each of the individual deals on their own merit, and then the bigger kind of story we have coming together as a company. And I think it's starting to get really exciting.
And you're going out to some conferences, I believe, over the next couple of months as well, and that's kind of the story that you're going to be telling there, I suppose.
Yeah, no, for sure. That, hey, the bigger models, the business model is working, and at the project level, we're starting to see discoveries materialize. So it matters.
Who are you targeting with these conferences? I know you're going to Europe. Do you want to expand the shareholder base in Europe, or what are you hoping for here?
Yeah, we're heading to Europe. We have some really great shareholders already out of Europe, so it's as much catching up with existing shareholders and answering these exact questions in person. But we're also really looking to try to we love working with family offices and small funds out of Europe. They tend to have a very long-term view of investments, and I find that they look at things from a bit of a different lens. North American investors love them. They make up a big part of our shareholder base, but there's mostly a shorter term view on investments with North American investing groups. And what we're looking for is people that are going to buy into this story because they see what's happening at Swift, but they like the opportunity at Selena. They like the opportunity at Black Ridge. And they believe that we're going to keep on generating those kind of opportunities, and eventually something is going to hit that's very significant. So that's kind of the push in Europe.
Well, I'm glad to hear that, actually, that people on my side of the pond have a longer term view. And yeah, Chad, I wish you good luck on that trip, and hopefully speak soon, maybe on the back of that hole 7 or whatever you want. Always open for a chat, of course. Always enjoy our conversations. I'm letting you drop off now, though. Give you enough time to pack your bags and give me enough time to travel all the way up to the Yukon, where I've also been spending quite a lot of time lately, actually, digitally at least. Unfortunately, not physically. Unfortunately, I'm not there to watch the Northern Lights either. I'm mostly there to look for gold. And that's exactly what I'm doing here today. Luckily for everyone listening, though, I won't be the one doing all the talking, as I'm joined by David D'Onofrio, the CEO of White Gold Corp, an exploration company listed as WHGOF on the OTC in the US. as well as WGOO on the TSX Ventures Exchange in Canada, where an average of about 65,000 shares trades each day. I see a 52-week high of almost 42 cents and a 52-week low of 20 cents. There are 176 million shares outstanding, and with today's $46 million market cap, that means WGO is trading at about 26 cents per share. In addition to the 176 million shares outstanding, there are 15.8 million options, but do note, and to my surprise, there's no warrants at all, leaving the number of fully diluted shares at about 192 million. Management here owns 18% of the company, and an exact third, so that'd be 33.3%, is owned by two of the largest gold mining companies out there, with that being Agnico Eagle, who owns a smidge under 20%, and Kinross, who owns just over 13%, leaving less than 50% in the effective float, consisting of retail and, of course, a couple of institutions in between as well. The last officially filed financial statement on Setter Plus, which shows the numbers as of June 30, 2024, has over $3.2 million in current assets on it, mostly in cash and CE. So specifically $2.7 million that was at the time recorded as C and CE on the balance sheet. And there is almost $500,000 in prepaid expenses, as well as some receivables on top of that as well. Total liabilities sat at over $15 million, mostly in the form of a deferred income tax liability and contingencies relating to the deal with Kinross, which, by the way, the last two together, they account for the vast majority of that $15 million. So they account for over $14 million. So that, with the current liabilities sitting at just about $1.3 million in account payables mostly, but there's also a bit of a flow through share premium on top of that as well. In terms of operating expenses, a 6-month period that ended on June 30 this year costed White Gold a bit over $2 million if you account for everything. But if you take out the non-cash expenses like share-based compensation and depreciation, and in this case, some of the contingencies and royalty accretion, the cost falls to about $870,000 for the 6-month period, which is about $140,000 in average monthly administrative costs. The largest element of that administrative spend is what I would call shareholder communication. So it includes marketing, conferences, and offices. So if you count those three together, you're sitting at about $385,000 for the entire period. And so representing an average of 44% and an average monthly spend of $65,000 on those three things. As to exploration and evaluation, those get capitalized. So you'll find them under note 5 in the financials. And they show about $1.5 million in exploration and evaluation spend for the entire 6-month period, which is an average of $250,000 per month. And I don't see a detailed breakdown of those expenses here in the financials, but the way the company spends money is hopefully going to become clear later on in the conversation. But in summary, you've got $145,000 a month going into administrative costs, and $250,000 is going into exploration and evaluation related activities, leaving us with an exploration to administration ratio of about 1.7 to 1, meaning about 64% of the money goes into exploration and evaluation related activities and about 36% into administration. As always, though, please understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of June of this year, and it simply shows you what the finances look like on that exact date and nothing more. Finances, though, as I like saying, are a fluid thing, so it is imperative that by the time you're watching this, you visit the company's website as well as setterplus.ca to look at the most up-to-date numbers for yourself and make sure you're getting the full picture. For White Gold, that full picture is fully focused on the Yukon, but it's far from it being just one project. Actually, the company controls over 300,000 hectares of land, which is basically half the district. But the flagship project that they have shares its name with the corporation, so it's the White Gold project. And it includes 4 deposits that are close to each other with an over 2 million ounce resource between the 4 and between the indicated and inferred category of the NI 43-101. It's split about halfway in each category with average grades of 2.2 for the indicated and 1.5 grams per ton of gold for the inferred category. And again, those are average across the 4 deposits that the White Gold resource is spread between, with all 4 being relatively shallow and thus potentially open pittable. But the company believes that there is potential at depth here as well as along strike, by the way. So they say that there's more exploration upside, although we haven't seen much on that lately. So hopefully, again, I get to ask about that later on in the conversation. The company also has multiple early stage discoveries in the Yukon, so I won't go over all of them. There's basically 3 groups of projects. So we have advanced, a little less advanced, and early stage stuff. But I'll pick out 2, which were the focus of the recent exploration campaign, which started in June of this year. And that is Betty. So that one of those projects called Betty, and the other one is called QV. Betty is rather close to Newmont's Coffee gold deposit on one side, as well as even closer to the Casino porphyry deposit, currently owned by Western Copper and Gold on the other side. It's not yet clear what the deposit type that White Gold is after here at Betty is, because the setting allows for the potential presence of multiple different types of deposits, including a copper porphyry. It's actually copper moly gold porphyry in this case, or another intrusion-related deposit, or perhaps even an epithermal gold and silver system, or of course, maybe that's always the case, I suppose, maybe an orogenic gold deposit as well. So that already leaves us a few question marks, which again, David and I will hopefully get to later on in the conversation. QV is the second target. As I mentioned, that's where in 2023, the company identified a 1 kilometer long golden soil anomaly, which is close to one of the deposits making up the white gold project resource, which this QV target seems to look a lot like, suggesting a similar style of mineralization. Now, the current exploration program, though, has actually already more than doubled the strike length at QV of that anomaly, so it's about 2.2 kilometers, as well as surface rock sampling has encountered gold associated with associated anomalous silver and tellurium in altered and mineralized intrusive rocks over a 1.2 kilometer strike or section of that 2.2 kilometer anomaly. So what the company is doing right now is preparing to drill it, and hopefully, again, we'll get more information on it later on. Again, too much land, too many targets to go through here in this summary, but there sure are more, and maybe we touch upon them as well in the discussion here with David, but I'm rushing to shut up already and let you do the talking here, David, because this is your first time on the CEO barbecue. So there's a couple of obligatory first questions that we have to go through, with the first one being, who are you and why should I trust you with my money?
Well, thanks for having me. That was a wonderful overview. One of the more fulsome ones it's nice to hear back the story, the way that information is interpreted in the market. I think that was a good overview. A couple of things to clarify there. So David D'Onofrio, CEO of White Gold Corp. I'm also a principal with Power One Capital Group based in Toronto. We're a merchant bank. We're technically sector diversified, but mining exploration has been the primary focus of our business for about 25 years now. Founder is Pat DiCapo. He's really built for himself and our firm an incredible reputation in the exploration finance industry. And we've been fortunate enough to have been involved with a number of very high-profile success stories over the years. And from our perspective, we're principal investors first, and we're looking for opportunities to get in early, work with teams or work with projects and help build out teams where we can start from a grassroots opportunity, have exploration success, and eventually sell that to a major. That's our goal with all these types of companies. And through the years, through the success, we've really been able to sort of help, I would say, hone in on an approach that, listen, it's a risky business. There's no doubting that, but sort of mitigate the risk to the best extent possible. Some of the names that some of you and some of your viewers may be familiar with, starting way back, really Resources, that was a company we took public. That's now Fruta del Norte, being run by the Lundin family. Obviously a wonderful deposit. We sold that to Kinross way back when. And then we went on to work with Patrick Anderson and the team to do Dalradian Resources in Ireland, another great discovery. That's on the gold side. We've been involved in many other minerals, lithium, for example. We actually took Lithium Americas public as founding investors and partnered with Waldo Perez. That's gone on to do tremendous things. This was, so early on, 2010. Tesla wasn't even public. Nobody knew what lithium was for. But we really do pride ourselves of getting in early on trends. And it's not always the easiest because, you really have to be able to stick it out. But when we believe in a sector or a thesis, we put our money where our mouth is, and our model is to bring the right pieces of the puzzle together early on. So if and when the company does have success, they have the right audience there, whether it's other members of the institutional community to provide additional capital, whether it's other members in the brokerage community to be able to provide analyst coverage, sales, trading, marketing, all those kind of good things. And when we do work with good people, we're now in a position where we're fortunate enough to work with them on their second and third projects. And I think the people, as you likely aware, are such a big part of the equation here, in addition to, other metrics, jurisdictions, stuff like that we can talk about. And we were fortunate to then go on and work with Waldo Perez on neolithium again, which was another great discovery in Argentina that was acquired by Zijin a few years ago. Some other examples on the precious metal side, you may be aware of, very recent stuff. Oryx Resources, we partnered with Hayadon and Alan Friedman, probably people you'd be familiar with. That was sold to B2 Gold. Then we partnered with them and Ross Beatty to start Osino Resources, and also in Namibia that was vended to them. More currently, we're very, very involved with another amazing discovery in Colombia called the company's called Collective Mining. It's run by Ari Sussman. He was the founder and our partner of Continental Gold. Again, that was sold. So what I'm going with here is, not to brag, there's a lot of ones that don't work out as well. It's, we're at our nice phase where we're working with people now on their second and third projects, right? So we like the people, we like how they work, we understand their approach to exploration, and it's really helped us mitigate risks. And white gold is fitting very much into that checklist of really sort of addressing all the factors that we think are the most important when identifying an opportunity. Mm-hmm. And what I mean by that, and not every situation is the same, but we look at stuff like jurisdiction, from obviously a geological potential, from support, whether it's government support, First Nation support, all these different stakeholders, very, very important. What else is happening in the district? How explored has it been, and who else may be interested in that area? And from the white gold perspective, particularly, it's actually a very unique time. Like, the Yukon, this part of the Yukon, it's called the Klondike District, which was the epicenter of the big gold rush 125 years ago, right? We've all seen the pictures. People basically risk their entire lives to get to the Yukon with their sleuth pans and look for riches. Now, they have, over the years, been an incredible amount of gold that's been found in this area. On record, it's over 20 million ounces of placer gold has been mined for this area. Mm-hmm. My guess is probably a lot more than that. Statistically, from other areas in the world where you have major placer discoveries, there's usually 2 to 3 times more gold in the hard rock. So what happened? How come 125 years ago they found all this gold and nobody went there, right? That's an interesting question. Well, the first person that we knew of that went there to do the work was a guy by the name of Sean Ryan. He's a prospector. He comes from the Timmins camp, and he sort of had a perspective of thinking big. He wanted to look for an opportunity where he could, apply his unique approach to prospecting in an area that when he's successful, he would be able to really do something big. I think in this business, you want to be taking your investment and looking, the rewards have to be big, right? There's, like I mentioned, there's a lot of risk. So when it works, you want these things to work. And by working, I think at the end game, you're looking at it 5, 10, 20 time multiple on your investment. What Sean realized, he found this area, he saw that the history was there, he saw there was little work that's been done in modern times, modern technology. So that was really attractive to him. He went there, and what did he find? And this is the first question we asked, right? So Sean is our partner. I'll get a little bit into the history of how that came. But what he found was this area of the Yukon was not glaciated like the majority of Canada and a lot of places around the world. Most prospectors, their tool is outcrop. See the outcrop, they take the samples, they bring that to the lab. That's what they then use. There's no outcrop. There's only 2% of this area of the Yukon that shows outcrop. So how do you look for the gold? Doesn't fit in most people's playbook. They just didn't bother looking there, right? It makes no sense that Alaska, you have so much gold, BC, you have so much gold. It's part of the same belt. How, or gold and other metals, why is it not there? So Sean spent a lot of time doing a lot of research, and the tool that he found to be most applicable in this area was soil sampling. So he developed a protocol, he used all the most recent technologies he could find. And this is starting in sort of like 2000 and probably 4, 5, 6. Did a lot of the early legwork himself to identify what he thought would be mineralized systems, or the haystacks as he calls them. And from that point, he would need, because he needed access to more capital, to really sort of take the next step, which is stuff, which is diamond drilling, right? At the end of the day, that's going to tell you where the proof is in the pudding. And remarkably, his work led to two major discoveries almost immediately. The first was the coffee deposit, which you mentioned Newmont is now owned, and is, should have actually been in production already if they didn't get bought by Goldcarp. Phenomenal discovery. That was Sean's, 4 million ounces at the time, if you include the sulfides. And the next one was the Golden Saddle, which is part of White Gold. So remarkably, which you never see happens, you have a guy with a theory go make two major multi-million ounce discoveries back to back within a couple of years in an area that see no work, but in an area that's in a phenomenal jurisdiction. So Sean, in the backs of that, came to us at Power One, and what he did smartly, and what really excited us and what really excited our major mining company partners, was he then went and tied up the district. So now we have an area which everyone has this wonderful prolific history. Not too much work has been done. The little bit of work that got done is remarkably successful, and now we had an opportunity to basically own it all. So from our perspective, that really, really was an appealing opportunity to be involved with. And what our dream was, and it's starting to play out, is imagine you could go back in time and stake and own the majority of Val-d'Or or the Timmins Camp or the Nevada Goldfields, one of these huge, huge districts with multi tens of millions of ounces of gold, and own it all in one company. Well, that's the best case scenario you could ever dream about, and that's what we thought the potential was here. And we signed up with Sean, we partnered with him, and on the backs of that, we showed it to a few majors. And not surprisingly, all of them were very interested to partner with us just because of the uniqueness of the opportunity. And from that point forward, we've continued to do our work. And I don't know if you want to jump in with some questions and,
Yes.
and start to have the success that we've had over the years with these, obviously growing our flagship deposit now, which is about 2.1 million ounces in all categories. The grade is remarkable, just under 2 grams a ton. It's actually the 5th highest grade deposit over 2 million ounces owned by a junior in Canada. And then take that and what we've learned in that success and apply it to other areas of the district to go and make new discoveries.
I do want to dive into what exactly you're doing with that deposit, because you have a lot of other things going on at the same time. But there's a couple of other questions that I have before that. I call them my smell test before we actually get to grilling. Management and insiders are noted at 18% ownership. What percentage of that is you personally, David, and what's your average cost of capital?
So I think me personally, I probably have the insiders are basically 3 groups. It's Sean Ryan, and it's Power One. And then within Power One, there's Pat DiCapo, and then there's myself, and then sort of the other guys in the Power One group. Myself personally, I probably have about maybe 2.5–3% of the company. My average cost is certainly higher than where the share price is today. I think I probably personally have $1 million invested in that. The majority of the balance of that is Pat. Also, listen, we put our money where our mouth is. I told you, we're a merchant bank. Everything we do, we're the largest investor, dollar-wise. Except maybe in this case, we have major mining companies who have put in more dollars than we have. But we support it all the way along. And even if you check your steady filings, I've been buying in the market myself recently up to in the 40s. And why? Because I believe this is a phenomenal opportunity. And when you have a real asset, if this is my merchant banking Power One hat on, you got to hang on to it, because listen, the cycles come and go, areas get hot and cold. But the perfect example I'll give you is uranium. We have an incredibly strong uranium portfolio right now in Power One. People say, "Oh, you guys are so smart. How did you time?" Well, listen. We didn't time it. We've owned this portfolio now for 10 years, right? We had good assets in good places. One particular example is Encore Energy. It now has 2 facilities or 2 sites in production in America. That company, we've owned it for over 10 years now. And for the longest time, whether it's Fukushima, nobody cared about that. You couldn't give shares away. But the CEO would come in, every couple of years, listen, this is what I need to hold my tenements and keep the lights on, keep my team together. And we supported it. And we supported it because we had the view to come back. Fast forward, it's now New York Stock Exchange listed. It's now $1 billion market cap. It's now in production. So when you have a good asset, the time will come. Obviously, you want it to come sooner rather than later. I think in this gold cycle, we've started to see the majors have their move, the mid-tiers have their move, the juniors have not moved. So that, in my mind, is the opportunity for the biggest sort of near-term re-rating potential.
Yeah, that's it. And again, I want to talk about how you're going to get there more specifically. But you bring up a good point, and that is that this is not the only company you're involved with. I also see that you've been buying shares of Lithium Ionic Corp, and I believe you do have other positions. You're active with the merchant bank, as you just told me. How important is West Gold as an investment to you? That's what I'm after. That's why I'm asking what's your average cost of capital.
We never, or very, very rarely, take management positions. Usually we have great relationships with the CEOs. Sometimes we'll go on the board if we think, like a lot of these junior companies, they don't have the resources to build out full management teams that they need. And our perspective is we like to keep overhead costs very lean. And what happened with the White Gold situation, why I'm in the chair as a CEO, which is really sort of like the Power One team as a group kind of in that position. Sean Ryan, to his credit, when he came to us to partner, he basically he indicated that, listen, he wanted to focus on doing what he's good at and what he liked, which is the technical work. He didn't want to, have the burden of managing the capital markets, the accounting, the finance, the CFO, all the other stuff that's the responsibility of a CEO in a junior company. And that was a really, really excellent suggestion on his part, because what does that do? It straps that individual from their time and their capacity, and it also forces them sometimes to do stuff that, is not really their strength. So we decided to split what is a normal CEO role into two capacities. And so Sean's doing all the technical stuff. Me, the Power One group, and our network is basically doing everything else. And what also that's done is allowed us to really bring down the overhead. Sean doesn't take a salary. Us for our entire group takes, a modest amount, which is less than even half of what a normal CEO salary would be. And, you did touch on some of those ratios early on about, overhead to in the ground ratio. That was, you wisely point out, that's a point in time. So the first half of the year, that's not really, we started our work in the Yukon in June or May. Right. So the first half of the year is basically all corporate overhead salaries type of stuff. Then the exploration expenditures sort of start from June for the balance half of the year. So that ratio is going to vary. If you look at, maybe go back and look at the last few Decembers, you get a better picture when you look at the full 12 months of it. So we're very cognizant of keeping administrative G&A costs down. We want as much money going to the ground as possible. And between my time, Sean's time, and our group's time, that's probably more than you see a traditional CEO, CFO be able to give. And you have the leverage of an entire team doing the work of what's sometimes burden on one individual.
That's a good point about you stepping in as a CEO where you typically don't step in. Would you want to keep the CEO position? Is the idea for you to remain the CEO until the story has concluded in whatever way, or are you actively looking out for a new CEO?
I think the answer to that question lies in how does the corporate strategy play out here, right? This company was put together to be a project generator. In our view, we wanted to go, our team's core competency is greenfield exploration. Now, we do have a project that now has grown to have some considerable mass to it. So now that's not a greenfield exploration project. So what is it that's going to happen with that project? How does that affect the corporate management of the position? I think between myself, the team, the capacity is there. If there was ever a situation where there was a better person to be in the chair than me, by all means, right? I'm not in any interest. Like, unfortunately, there's a knock on our industry. There's guys that these are lifestyle companies. They just want to keep the lights on and keep their corporate credit cards and the conferences and all that kind of stuff. From our perspective, we're investors first. We're fiduciaries to other people that have invested, alongside of us. And our goal is to optimize the value of the company and more specifically for the share prices to increase. Some management teams, they talk about how market caps have gone up, but if share prices are not going up, then it's really done no benefit to the investor. So that's our view, and from our perspective, that's what we're working towards, and whatever makes most sense to help achieve that is fair game.
Do you or any of the other team members own any royalties on the projects personally?
Sean Ryan owns the royalties, yeah.
Okay. How do you manage it? And he owns shares of the company, I suppose, as well.
Correct.
Okay.
He's like the fourth largest shareholder, I think.
Is he on your board?
Yes.
Yeah. Okay. How do you manage that relationship there between his incentive for making the royalty work versus his incentive for making the stock price go up? Because these two things are not always the same thing.
He's always been, it's never been a point of contention. He's always been aligned with us in doing what it is that makes the stock price go up. And it's an interesting conversation every year as we're looking to allocate our budget. I know there's our meat and potatoes. I know that the more we drill, the more work we do on the Golden Saddle, that's going to continue to grow. Now, as a junior mining company, what's going to get the market more excited? How do you get the best bang for your buck for a dollar? Is it adding a few 100,000 ounces a year, or is it going to make a brand new discovery? Right. So we've always tilted towards working in the best interest of game-changing type exploration. But in the meantime, listen, we're still prudent. We know there's value there, so we continue to, add the value in that perspective. But it's mostly been geared towards real sort of game-changing opportunities. Because back to the original point, this is set up to be a project generator. Now we haven't generated a project yet, just because we've had this unique opportunity with the Golden Saddle. But what ideally we'd like to do is, once we have a project, once we've shown the scale, look to transact on that, pay the shareholders, and use some of the additional capital to continue the exploration. Like, we really think there's decades of work that can be done here. But the more money we can use from those types of transactions versus financings, that's obviously going to be less dilutive. Preserve the capital table, which again is in our interest as shareholders, to help the share prices increase.
Well, that about concludes my smell test, as I call it, before actually getting into the actual barbecuing. Let's talk about what you're doing right now, though, and where you really want to take the company from here, because you mentioned that it was designed to be a prospect generator from the beginning. But again, you have many targets right now, and an advanced deposit that you believe can grow at depth along strike, a discovery at Betty that needs defining, a potential new discovery at QV that needs drilling, all of which not inexpensive. So what do? Do you spin off some of them? Are you actively looking for options partners? How do you roll out this strategy of a project or a prospect generator?
Yeah. So that's a great question, and that's something that's top of mind, and it's been particularly top of mind recently. And so there's, I would say, 2 or 3 different perspectives that are being entertained currently. And they have been. This is nothing new, but the market is, I think, more constructive today than it has been in the last 3 years for these types of opportunities, especially with some of these other mining companies now really performing well. Stock prices appreciated, cash positions are better. They seem to be more active in these types of things. I don't know if you saw the article in the Globe and Mail 2 days ago where it talked about exactly that. So we always have 2 great mining companies as partners, right? They have a seat at the table. They're looking at things. There's a lot of interest. They like what they're doing. They're involved in guiding us towards how we can increase the value of those opportunities. Their interest would be more so on the more advanced type projects, but there's a lot of interest in those projects, right? For a mid-tier company with maybe one asset not in the best place in the world, to have something of this scale in a great place is of interest. So there are a number of conversations that are being entertained right now, and those continue to grow. And it was interesting. I think you were at Beaver Creek as well. you saw the move. Now it's a bit of an interesting situation. These guys have great market caps, the juniors don't. They're sort of like licking their chops here for opportunities, right? And they'd almost be remiss not to start gobbling these things up. So you see a lot more activity from that regard. I think the corporate development teams in these companies tell me that they're, the busy they ever have. And we certainly see it, right? People with interest, CAs, all this kind of stuff. So there's that. Now there's the earlier stage opportunities. There's new discovery type stuff. Does somebody come and buy one of those? Maybe. Is there other interested parties that might have a different type of a structure that might be of interest? Maybe. And what's been really unique for us in the last year or so, which, listen, it's a bit of a double-edged sword. When you have a lot of opportunity, the challenge is how do you allocate your budget, especially in the last few recent years where, capital has not been overly abundant in the industry, as you know. So you want to take what you do and try to get the most value out of it. We also, and not surprisingly, have, in addition to our gold, which is the focus for sure, some very interesting critical mineral opportunities, right? You mentioned casino. We're contiguous to casino and our Betty and a couple other properties, our Peddler, our Hayes. That's the largest undeveloped critical mineral deposit in the planet, or at least in Canada for sure. The copper, the gold. We have two other properties right beside with almost an exact same similar signature, the molybdenum, a great indicator, that's 15 kilometers away. So now there's interest and discussions on what do we do with those. So, as a company, is it practical? Is it feasible to work on all of them? Maybe. But does it make more sense to have sort of different groups, helping along the way? That could be interesting too. So I didn't really answer your question because I don't have an exact answer to the question today, but these are certainly things that are very topical and actively being evaluated currently with, real prospective opportunities.
What's your timeline to have a more direct strategy for how you're going to realize this value?
Well, we have a strategy. It's just now, talking to the different counterparties, right? So the timeline is today. Like these are, daily matters that are being, engaged in, right? It's not like, okay, here's our strategy. Let's go in 6 months and start to reach out to people or, maybe engage a banker to run a process. It is fluid, but it is like happening like now, and it's been happening for the last little while. Like there's been more activity in the last 3 months than in the last 3 years, I think, across, well, for us for sure, but a lot of these different juniors are starting to see that, which I think is really playing into a much more constructive environment.
But so essentially spin-offs are still on the table, potential options deals are still on the table, selling assets separately, all of that is still on the table.
Absolutely.
Okay. How much does the fact that you have two majors involved at the same time kind of influence that decision, though? Do they really have any decision sway here outside of their ownership voting structure?
So technically they have their shareholder rights. They have a right to nominate a director, which they haven't yet. And I think part of that is because we have very close working relationships with them. We really respect their opinion. They're great partners to have, obviously some of the best miners in the world. And we've been just so fortunate to have their guidance technically, corporately, along the way to work with. I would say, so by and large, it's been a great positive for the company. Maybe if you look at some of the, I would say, not challenge, but like, maybe some of the other side of that equation where it might have affected the company. Sometimes we'll have conversations with different parties and they'll say, oh, wow, we love this. I can't believe it. You're so, what a great asset you have. We'd love to, take a look at it. But like, obviously there's no chance for us to do anything because you already have your dance partners. Well, listen, our partners, I think, are in favor of whatever's best for, the company as shareholders, because at the end of the day, they're big shareholders. So I would say nothing is off the table, right? We've seen, especially more recently, a lot of these companies partner with each other, right? Depending on what their current strategy is, depending on what their current resources are. And, that's my sense of the relationship. And, we'll see, if, as and when these things start to happen, how that plays out. But, I think by and large, it's a positive, although maybe it could have been perceived otherwise by their people. So, want to make sure everyone is clear on the reality of the situation.
Yeah. What is the relationship between them two, though, in relation to you, if that makes sense? Because in my experience, large gold companies, there's a lot of rivalry going on, especially when they operate kind of in the
Yeah.
same setting. So, is there? And what I really want to get out of this is white gold specifically. Like, is one of them pulling you one side and the other one is pulling you the other side, or is it how are they dealing with each
Not
other?
at all. Yeah, you're right. It is unique, especially it's even more unique to be involved in a company, of a junior explorer. But when the deal got done for Kinross to come in, came in second, we clearly wanted Agnico to be well aware and to really get their blessing. They were our first partner, and we were very respectful of our partners because these are long-term relationships, right? And in fact, which was amazing to me, there was a meeting between their respective CEOs, which were Sean Boyd and at the time, and Paul Rollinson, and they literally sat down to talk about it to ensure that they were aligned and saw eye to eye. And I think, Sean, he's just he did such a great job building Nico. He loves Canada, and he's really enthused to continue to advance mining and exploration in Canada. And, Paul shares a lot of those same views. Didn't take long for them to sort of come to realize that, they would be great partners or co-shareholders in this venture, which really they look at White Gold as their exploration arm in the Yukon. This prolific area, there's so much opportunity, for them, their size, they're not really built to explore it, but they love it, they believe it, they believe there's, so much value there. So they're going to kind of let us go and do our work. And, they're happy to back the guy who's been more successful than anyone on the planet in making discoveries in this part of Canada.
Would they also be happy to back you more? How should I call it? More specifically, as in, would the idea be to get them to sign a JV if you, I don't know, zone in on that source that you're looking for and
I
need a
think
lot
so,
more
right?
drilling?
Like, we wanted to, get the critical mass of they're more interested in the bigger stuff, right? So I think now that the Golden Saddle has gotten to that critical mass and they've got a lot bigger themselves in the meantime, they would 100% be interested in or potentially supportive of that. How that exactly looks, like I said, these are, current conversations, but for sure, like that's what they're in it for, right?
What are they looking for, though, in that case? Like, what's maybe a threshold they have to cross? And maybe this is from your investment banking experience as well. What would majors typically look for in this case before they get involved on a JV level?
They haven't given us a number specifically. I think it's grown a little, just listen, I talk to a lot of majors, right? Through White Gold, or other ventures we're involved with. And the bigger they are, the more the size they need to sort of really get them interested. But what's also a fact you have to understand is they look at platforms. So if they say, we want 400,000 ounces of production a year to be able to, kind of sink our teeth into something, that doesn't necessarily have to be from one single deposit. And it doesn't have to be today, right? As long as they have a view to getting there, that's what they'll, start to make moves based upon. So, and they view Yukon, sort of BC, Alaska, kind of northern BC, Alaska, all sort of part of that same platform. So it might be part of a bigger decision. Listen, all these companies have been busy kind of making some other, corporately on their own fronts. But they've always said, like, just keep doing what you're doing. We like what you're doing. And then, when the next step is there, I think they'll be, very open to engage and willing to support, what we think it is. And we think, like this project, we haven't announced the PEA yet. We've done our own internal studies. We did one in 2020. It was phenomenally robust. And, moving that forward today, the deposit's gotten bigger. We were able to increase the mining throughput rates, and it's gotten even more robust. So we're looking to potentially upgrade that to a 43101 standard so we can release to the market. I think people will be pretty blown away by the types of economics that this type of a project can produce, because as you mentioned, it comes right to surface. It's mainly indicated the core of the deposit, 1 million ounces, is about 3 grams, right? Like that's a moneymaker. And it depends. And it's interesting how the different mining companies from different parts of the world look at it. The Canadian, the North American guys, they just want to say, keep getting it built bigger, bigger, bigger. Whereas sometimes the Australian guys, they're like, no, wow, you have 1 million ounces at 3 grams. Let's start mining that and then grow it as we go. So it's an interesting dynamic. But listen, as shareholders, we want to start. I think we're at the time in this cycle now where we're seeing the M&A start to pick up. We're going to see it to continue, and we really kind of want to make sure we got our dance partners, fully aligned here to optimize the opportunity for the next, I don't know, what, years ahead. As I think everyone here probably believes that we're entering into a major commodity cycle, particularly with the precious metals.
I don't know about believe. I do know about hoping. That's the only thing we have, I suppose, in the end. When do you want to have that PEA out, though?
So that hasn't been decided formally. It's something that's on the docket here to discuss for, I think next year, potentially.
Okay. H1, H2?
Once we announce our plans, which is usually sometimes in Q1, then I'll have better visibility on that.
Right. Okay. I do want to talk about some of the recent exploration that you've been doing this year. You've now started focusing on the QV target, it seems. What about Betty, though? Is it something still happening there? I know
Yeah,
the
absolutely.
intention was.
I wish as a company I had unlimited capital and time, because there's so much work to be done here, right? Now, we used to sort of have larger programs up until COVID. We had to shrink them at that point in time just to manage camp sizes. And the last couple of years, with the market being we wanted to make sure we had enough to stay active, advance, and grow the value of our projects. But again, we're sensitive to dilution just because, we're shareholders first. So we're sort of picking and choosing between, it doesn't necessarily, if something doesn't get looked at right away, doesn't mean we don't like it. It's just, we're prioritizing. If we have a discovery, okay, that's good, it's exciting, but we think we have another discovery here. Sometimes, you maybe do a little bit of work here, but you want to go so we're always looking for company really changing type of events. So the Betty, amazing, right? It's a brand new discovery, very high grades from surface. First of all, Betty has 6 different targets. They're all a little bit different. It's the Betty 4 that we had the real success with the last few years, hitting 50 meters or 3.5 grams from surface on several holes, grades up as high as 9 grams over 18 meters. And what's also extremely exciting about that project is it's right contiguous to the coffee project. It's on the same fault system. The coffee project, and as an investor, you're always looking for a catalyst, right? What's next? I think you saw Beaver Creek. Nobody doubts that the juniors are undervalued, especially relative to commodity prices, everything else. But what's going to be that catalyst to kind of get the sector going, which is the most important for everything here as an investor? It's flows of funds. Once the funds, if and when they do come into the sector, all of these boats are going to rise with the tide. Theoretically, the ones with the best assets are going to go the first and the farthest, which I think white gold is certainly one of those. But in terms of specific catalyst for us is that coffee project. Unfortunately, when Gold Corp was acquired by Newmont, so Gold Corp bought that for $550 million. That's at about 2.1 million ounces now, looking at just the oxides. We're at about 2.1 million ounces now. We're not oxides. We'd be a mill. Our grade is 1.9, they're about 1.2. And, look at our whole market cap's only $40 million, right? So, listen, the market has changed. Gold Corp was going to race to put that into production by 2020. What would have been phenomenal about that is, number one, once you have, when's a camp? We know there's been 20 million ounces of placer gold. We know there's been another, 5 million ounces discovered by Sean Ryan in our district, half coffee, half what we have. Casinos there with 20 million ounces. That's, 40, 50 million ounces, but there's not one in production. So is it a camp yet? No. Once you have a facility, now that changes the economics or everything else. But what's also important about that is part of building that mine, there's a network of placer roads in our area of the Yukon that goes from Dawson down to the coffee. The government has set aside or provided capital, which is funded to upgrade those roads and pave them to haul grade roads in our area and actually 2 other areas of the Yukon. But that's all contingent on the mine going into production. So had the mine been built, the road been built, and now the rest of our properties are all road accessible, which is great, makes everything a lot cheaper, and it makes re-rates economics. When you're in the middle of nowhere, not that we are, but like if you in general, you got to find 2 million ounces to make it work. When you're in a camp like Timmins, like Quebec, once you have a couple of facilities running, you find 2, 3, 400,000 ounces. Boom, that's a satellite pit for your mill. So it really brings a lot of more opportunity. Anyways, fast forward to today, that got delayed. People have no idea what Newmont's done, right? They're a big company. People in the Yukon, they think it's gone quiet because really there's only 3 companies there that own everything. It's Newmont, it's us, Klondike Gold is there. So not a lot of noise. Newmont has done a tremendous amount of drilling, and they've more importantly advanced the project to the permitting stages. They basically put a bow on it now, and now it's up for sale. So as that gets acquired here, which I understand should be by the end of Q1, whoever buys it, I would assume, is going to look to move it forward to production. Part of the production is the road, and now we're back to where we thought we'd be a few years ago with a new party in town, waving the flag, doing a lot of good work, bringing attention to our area, bringing a road in, which, you know, we benefit more than anyone else because we really own the district. And it's, you know, we have a huge land package, but that land package is something that Sean's compiled for 15 years now. So it's the best of the best. You know, we really have 80% of the best targets in the Yukon. So exciting to look for that as a near-term catalyst, in addition to the work we've done, which you've asked. And sorry, I got off track there. But where have we been doing? The Betty, extremely interesting. Also down in that area, like that, I believe is total elephant country. We have these 2 other properties, the Peddler and the Haze. Those are actually copper, porphyry, molybdenum type targets. They look quite similar to the casino. So these porphyries happen in clusters. You have one of the largest porphyries in Canada for sure, maybe the world, you know, literally a stone's throw away. Very little work's been done on them. The geophysics, the geological work we've done in the last couple of years have made them more and more prospective, and they really have not seen a drill hole to test that. So that's not work that got done this year. Something more interesting, you know, I'll call that the critical minerals bucket. That's something you can look forward to going forward. But the Betty we love because of where it is, because of what we've seen with the drilling, and then these other targets on the QV. So what we've been doing there, and this is actually your question, like how do the partners help support this, is Nico's idea. So as a junior, you're going to get the best bang for your buck by making new discoveries versus delineating. So say you have a project there, it's got critical mass, but instead of, you know, if you're going to drill whatever number of meters you have in your budget to drill, just delineating it, go look for new discoveries in a radius, a small radius to that core flagship project that will be incorporated in that project, because now anything you find there will sort of be accretive to your overall project. And statistically, the best place to discover more gold is near existing deposits. So we've taken that approach. It's worked. We made we made 2 new discoveries. One is there's a mineralized trend that's 2 kilometers to the west of our flagship deposit. Hardly no work got done on that. It's 6 kilometers long. We drilled 1 target there 2 and 3 years ago. And with a small amount of drilling, we found hundreds of thousands of ounces of gold. So that got added into our flagship deposit. And then we followed that trend further north onto our QV property, and we found this massive, what's now 2 kilometer long target. We have a deposit up there, a couple 100,000 ounces, also on trend. So we're starting to see this like pearls on a string type thing, and we're very interested in that target as well. So we're doing some work on that also.
How much is all that work gonna cost you, and how much money do you have left? I mean, at the end of June, I mentioned you had almost $3 million in cash or cash equivalents.
So our cadence is we typically raise, you know, flow through once a year. So that, you know, like I said, we want all our money going into the ground. So when, as a shareholder investor, you see that, you know that money's to get invested, and we typically raise with the flow through. You got to basically spend it all within 1 year, and then that's been our sort of cadence to do it once a year, and you know. Presumably, you know, that'll continue. We always make sure we have a buffer of hard cash to last us for quite a long time, just in case the market's not, you know, receptive to that type of a financing. We've been fortunate to have basically the same groups of investors supporting us every year. So nothing's been sort of decided at this point in time, but presumably that will continue to be the pattern going forward.
I thought you had 2 years to 2 calendar years to spend the flow through. So, but if you raise it in December, then essentially it is only 1 year.
Correct. Yeah, it's called the look back rule. That's right.
Yeah. Yeah. So, okay. So how much money? So you're going to have enough money to finish this drill program though, and have some news into the market.
Drill program, we'll have always a couple $1 million on hand, and just as a buffer, and just in case to time, so we're not ever up against the wall in terms of timing the flow through raises.
And you're running about 150, let's round it up to 150 grand a month in G&A. So that's almost 1.8 million bucks a year. So you're going to have to raise 2 million hard cash too.
It's a little bit less than that the way it works out. I know that's maybe what the numbers show, and I don't know if like top of my head like what's in there exactly. And then, like I said, sometimes you're looking at like part of the year where there's more activity in G&A than there is sort of in the other half of the year when we're in the field season. But yeah, it's somewhere between 100, a little bit over 100,000 a year probably.
Yeah, right. What about
and a lot of that's obviously discretionary.
Anything else that might be stopping you or slowing you down? Permits, First Nations. I know you're in the Yukon. It's something I want to touch upon as well.
Yeah, that's a great thing to touch upon, and it's extremely important to us. It has been since day one. A lot of places, the Yukon in particular, it's a district of it's a territory of districts. So depending where you are, you're going to have unique First Nation groups that you're going to deal with. The Yukon's done a really great job in settling agreements with the majority of their First Nation. So they're fully settled. You sort of know what you're getting into in each of the different areas. In our district, we're primarily dealing with the Trondequichin, amongst some others. And we have made it very important to develop a good relationship with them. We meet regularly. We want to ensure that they're aware of what we're doing. We're very respectful of their traditional territories. And, they have been involved in mining in certain capacities for a long time, because this placer mining that's been going on for over 100 years is in their traditional territories. So we find them to be supportive. Obviously, they're very mindful and want things to be done properly, which absolutely is the right thing, and we'll always do that. So it's for us as White Gold, it's been a positive relationship for sure, and we believe it's very supportive. The government is certainly extremely supportive of mining exploration. They know that that's their number one economic driver in the territory.
Yeah. At the same time, though, after what happened with Victoria Gold and their leach pad failure, open pit mining is frowned upon right now. Do you think that's going to remain the case? Could it be a challenge for you in the White Gold project?
I would say open pit mining is frowned upon. That was a heap leach, right? So maybe heap leach is going to come under more scrutiny. White Gold's projects are not heap leach. I think, as happens with these types of issues, it brings more scrutiny, which, listen, things need to be done correctly. Let's see what the investigations find, what caused the issue. If it was just an isolated event, something that could have been avoided. But I think historically, these types of incidences, as thankfully nobody got hurt or died, they're quite isolated, and they get, addressed relatively quickly. And depending on the government, it'll sort of dictate how fast things get back up and running. And if you want to sort of think of, I don't want to say positive, but something that, if you could take as a positive come out, this really made the government be more vocal about how supportive they are of mining and in exploration, and it needed to happen. And they're got themselves so involved in this process because they want to facilitate that mine restarting. So listen, we'll see. Time will tell. For us, it has not really had an impact on our operations. Also, particularly, I think we're fortunate that we're not heap leach, but we've had our discussions with everyone, our First Nations governments, our provincial government, our territorial governments, and everything is sort of continuing to move forward.
Yeah. Well, I know we're up on our time here. Maybe next time we chat, we should invite Sean with us and do a little bit of a geo deep dive, see what you've been coming up with, because it is interesting. Betty's got a few theses that you're working with that it could be potential different mineralization styles. So that'll be interesting to get into as well. And maybe next time we can have Sean on.
Yeah, I think you should definitely have Sean on. He's Mr. Yukon. He's the guy that went there with the thesis. He's the guy who's now, proven his thesis to be correct. We've scratched the surface. He saw what led to the success. He sees what other indicators we have, and he really feels like we've cracked the code, right? So we've made millions of ounces of gold discoveries. He thinks there's millions of ounces of more discoveries. Listen, there's stuff on surface. Like we've just been doing surface exploration. Imagine you go to Timmins or other places in Quebec, you're now drilling 1,000 kilometers deep. We're literally exploring with a tulip auger to start. We're finding the gold. That's the lowest hanging fruit. We still think there's a lot of opportunity there, right? You have to understand. So the way I think I view white gold, it's almost like buying a basket of juniors. Typically, this would be 5 or 6 different companies on the size of a land package, but now you're paying for 5 management teams, marketing, all this stuff. You have one group. It's being guided by the person that's had the most success in the area. Most importantly, we have that core asset. The hardest thing in this business is technical success. To go and make a discovery, grow it to 2 million ounces, that's like a 1 in 10,000 odds type of a chance. So that's already been done. That's been done on historic dollars. Like there's been $150 million in 15 years put into that. So if you're starting new, you got to look at what that's going to take going forward. It's probably multiples of that. So you have that in the bank. I think at a minimum, we're trading at $20 an ounce probably, which is probably a little bit better than most of our peers. On a historic basis, these things should be trading at probably closer to $100 an ounce. So I think there's a huge rating potential there. A lot of interest, like we've been mentioning. Plus, you have all this blue sky discovery upside with the Betty, with the QV, with the Peddler and Hayes, a bunch of these critical mineral targets. So you're basically investing in a whole district in white gold. That's what we loved about it. That's what we think the opportunity is. I think as hopefully funds start to come back to this sector, you're going to see people really, show more and more interest for companies like I mentioned, fifth highest grade deposit over 2 million ounces in Canada. I think that's a tremendous asset to be in. Grade is so important from an economic perspective. And, we're really as more optimistic probably than we've ever been about the opportunities for additional new discoveries based on what we've seen that led to all our discovery success. We've been, fortunate to attract major shareholders that are the best mining companies in the world. I think they share that view. Yukon as a district is phenomenal. I bet you see almost every mining company in the world now starting to invest more and more in the Yukon. It is one of the few places I think that you can go where you have a great rule of law, great geological potential, and it's still so underexplored, with more and more government support being sort of announced all the time. So really, from our perspective, checks the boxes. And, I think the prospects at this point in time, from a risk reward perspective, are better than I've ever seen as a investor.
And that's David D'Onofrio of White Gold Corp, and it's whitegoldcorp.ca for people who want to know more. David, thank you so much for investing your time in me, and hopefully speak again soon.
Yeah, I'd love to. Thank you so much, and appreciate the interest. And you spend a lot of time digitally in the Yukon. You got to get to the Yukon. It's a wonderful place on the planet.
I feel invited, so I might at one point.
That is an official invitation. So this summer, I'd love to have you up there.